This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hey everybody, it's Aaron Norris with the Norris Group. Thanks for being here today. We are recording this on Monday, April 13th, the Investor Town Hall. We sort of came up with about a month ago before everything was locked down, thinking that things in April might be locked down. And this would be an interesting way to get some feedback by all of our friends all over the state. As we know, a lot of real estate investors have investments in a lot of different counties, and this is getting very difficult to track. So we have an incredible lineup of people who are helping us out today, and I just really appreciate them helping us out. You can send in questions as we go along for those of you on the call live, and we'll try to get to them. And of course, we're not attorneys. Amanda and Matt are CPAs, but just know that this is going to be, if you're listening to this later, things could change. We're recording this on Monday, April 13th, and tomorrow could be a totally different story. And please make sure you're paying attention to local information. We'll go through some updates really fast. Of course, as of April 3rd, we found another 6 million people applied for unemployment benefits. Last Tuesday, on April 6th, we had the California Judicial Council come out and on top of Newsom's eviction and foreclosure moratorium, made it a lot more onerous. So until the state, from how I understand it, until there is the state of emergency is lifted by the state of California, that date is when a 90-day hold would begin on both foreclosures and evictions. So we really don't know the date. So when you've got cities like Los Angeles doing a shelter in place until mid-May, you might not be able to look at starting an eviction cycle till much later this year. The Apartment Owners Association did do a presentation last week on April 7th about this and evictions in particular. I have a link on this slide if you're watching this on YouTube later. It's bit.ly/eviction stop. And this is going to throw you into the video exactly where they're talking about this issue and what you can and cannot do. It's not that much fun to listen to. It's a little depressing actually, but it's there for your enjoyment, and we really appreciate AOA putting that out and making it available for everyone. The Pandemic Unemployment Assistance Program, we've got money finally starting to hit the streets. This is part of the CARES Act, up to 36 weeks starting, let's see, February 2nd. It's an additional $600 per week for those on unemployment.
Excuse me, Aaron,
yes.
Would you mind sharing your screen, please?
Yes, I can do that. I didn't realize that it was somebody else's screen. Let's see. You know what's funny? I can't even see my own screen. Oh, jeez.
You can.
Oh, you can. Okay. Thank you. All right. So edd.ca.gov is where you're going to find out more information if you've got tenants that are on unemployment. I think a lot of landlords might be a little bit surprised how proactive they have to be, not only when it comes to the SBA information. You might have to help your tenants understand what's going on. For instance, if you rented to them as of the last year and they haven't filed taxes, if the government doesn't know where to send money, you probably need them to fill out a form so they can get that unemployment assistance and the free check that's coming their way. The EIDL loan, April 10th is when 1099 contractors can start applying for those. When it first came out, we as real estate investors could apply on their behalf and sort of roll them into the assistance we were looking for. That quickly changed. So last Friday, April 10th is the date that they can apply. You might want to let them know that. Property taxes, it doesn't look like California-wide. The county is different counties are going to allow people not to pay their taxes. They may help you a little bit by not charging late fees. But up on the screen, it's just sort of a funny quote. Newsom came out praising them that they were going to work with people, but I just sort of thought it was funny that, what did they say? Any delay in payments beyond April 10th property tax deadline, let's see, will tip local governments into insolvency at a time when our residents need us most. So I just sort of found it amusing that they're not willing to play ball, but we as landlords have to. Thought that was Ironic. Vacation rentals, please do your homework. Make sure it's very local. Other cities chiming in on what Riverside County did as far as banning any vacation rentals and short-term rentals that were not COVID related in some sort. Newport, Santa Cruz, and La Quinta, even though it's in Riverside County, they did their own overlay. Airbnb came out with a $250 million host relief fund. So if you're in the vacation rental space, just make sure you pay attention because the fine in Riverside County is not small. I believe it's up to $1,000 a day. So don't do that. Let's see, we covered moratorium and evictions. So this is the agenda tonight. We've got a very aggressive program. This is very TEDx style. 15 minutes, we're going to be jumping around the state to all of our friends and experts. So hopefully you enjoy today. Dad, before we jump into the show, is there anything you wanted to?
Yeah, I was just going to mention that there was a chart that you had in the beginning. It was the unemployment numbers, but I'll just verbally state them. For the last 3 weeks, we've had 3,300,000. This is for, the U.S., not the state of California. 3,300,000 U.S. weekly unemployment claim. Then it went to 6.8 million, then 6.6 million, combined for about 16 million in 3 weeks. The prior 3 weeks, it was less than 800,000. To multiple it 20 times. So that's an all-time record. I have a chart that goes all the way back to 1960, and I think the record for any one of the worst weeks was about 800,000.
Wow.
So this is unprecedented, and so it's going to be very interesting to see how this plays out. One of the things that you'd get to ask just a few of the people that we know that have different rental types.
Mm-hmm.
Okay, so talk to a gentleman that has predominantly industrial. And so they're small businesses. He's down rents 30% in the first month that he would be able to collect something that was, kind of after this kind of hit. So he's down 30%. Our own track record has been really great for our own personal rentals at 100% payment.
Mine as well, yeah.
Yeah, and then the loan payments, we have, tons of automatic payments that were 100% cleared. So that was great. So, but I'm sure we'll get more and more feedback. I talked to Christopher German about the apartments, and so far it's been pretty stable. He doesn't think it's early enough to really know. So he says next month and the month after we'll really kind of tell the story.
I was able to get my haircut this weekend, and he didn't know I was in real estate. And he was talking about his landlord really stuck it to him. She contacted him early this month and said, you know what, why don't you just send in half? And 3 weeks into it, she's like, you know what, I changed my mind. I need the rest. And he was selling all of his toys in his garage to make sure that he could pay rent. And he's like, so she's going to get an $1,800 bill of all the rat issues that I've gone ahead and taken care of. So his rent's $1,500. So instead of a
net,
instead of her, sticking to her original agreement of $750, she's about to get an $1,800 problem. And then I also got a real estate investor who was asking me questions because she was giving tenants gift cards and how to do that without causing problems. Like her landlord, her property management company didn't want her to forgive anything on their side. I'm like, yeah, just get gift cards, send them a note. I'm like, they would probably really, really appreciate that. And that way it's not in their books and whatnot. Don't make your property management's job any more difficult than it already is right now.
Okay.
So I've heard both sides, but now is the time. If you're a property manager, I don't think you want to create the us versus them if possible. It's just not the time.
No, and it's, I just sent an email to a friend of mine. I said, you spend all your life protecting your family by being financially secure. And in the last month, a lot of that feels unsecure, oddly enough. I mean, you go around when you got a mask on and the freeways are empty and you think, okay, what am I going to do tonight? You just start thinking I'll go to, no, you just have no list other than I'll just sit at home and play cribbage with my buddy. And it's fine, but things have changed. And we all can remember maybe a month or two in our life that if we lost a job 30 days later, maybe we would be homeless, that we didn't have the wherewithal to even survive a month. So I think it's a good thing to keep in mind that there are some people that we deal with that are there. And if they legitimately have lost their income through no fault of their own, because we have people in our family who both income are gone,
Yeah,
because they can't work, the place is closed. So,
and you really have to realize, you know, May's going to be more difficult for, in some ways, a lot of different ways. But people have been locked into their house for a month, going on 2. You're not going to always be dealing with rational people either. So just be patient.
just stay in, just avoid them.
Very funny. All right. All right. With that, what we're going to do, we've got Amanda Hahn and Matt MacFarland with Keystone CPA. If you missed the 2-hour special we did a few weeks ago, Matt, I'm handing it over to you, the presentation.
That's good.
If you missed the session we did 2 hours where we went through all the different financial programs that are available to us as real estate investors and also your tenants, you're going to find that on the norrisgroup.com/resources. That is sort of our landing page for all things national, state, and local having to do with real estate in general, from both the real estate investor side and the tenant side. So, well, thank you guys for coming back. I think you're going to do a quick intro of some of the programs that are out there, and then maybe an updates that we've ran into since we did that 2-hour session.
Yeah, sounds good. Thank you for having us. Appreciate everyone logging in, and it's gonna be a lot of information tonight from everybody. So hopefully people learn a lot of good stuff.
Yeah, so like Aaron said, we did a 1.5 to 2 hour podcast a week or 2 ago. So you know, we'll kind of go do an abbreviated version tonight of the things we went through before, and then mainly highlight some of the updates since the last podcast we did. So let's get right into it. You know, like Bruce and people can be expecting in their bank accounts, as you know, for married and head of household, along with the adjusted gross income phase out ranges. So some good news is that the IRS indicated that the first wave of direct deposits has already been dispersed. So I guess if you think you're eligible and you're expecting a direct deposit, now is the time to check your bank account, because it's possible that that's already been deposited into the account.
Yeah, and some other information came out just recently too. So one of the questions that came up was, well, what about people who don't have to file tax returns, right? So how are they going to get their information? Well, the IRS now has a website on a landing page on their website where you can, people who are non-filers, they can go in and enter their information, so name, social security number, bank account information, things like that, where they can verify who you are essentially, and then you know, give them a means to where to send the money for you.
Yeah, and the other thing you'll see on the screen is the IRS is in the process of setting up banking information. So for people who used to get refunds by check, you can now go on the IRS website, and well, you will be able to go on the IRS website in maybe mid-April to put in the information, your banking information, so you can get the money faster. Now, a common question we're getting a lot still is, you know, what income is it going to be based on? So currently it's going to be based on your most recently filed tax return, whether 2018 or 2019. If you haven't filed your 2019 return yet, but you expect to be in a lower income than 18, could make sense to get those filed. Now, the main point though to think about is ultimately the credit will be based on 2020 income. So I know for a lot of real estate investors, people are still gathering up their information, still working on strategies on should I maximize my write-offs or accelerate my depreciation. If you're able to use those strategies for 2020, you still will likely get that in the form of a tax credit on the 2020 return, even though your 18 and 19 income was higher and above the phase out. Okay.
The other nice thing about this is that this little section here on their webpage about where you can put in your information to get your payment. This is nice for the people filing returns, because as of a couple of weeks ago, we were getting a lot of questions like, well, I've moved since the last time I filed a return, or I didn't have direct deposit on my return last time. What do I do? And, you know, at that point, the only answer was, we'll file a change of address form and, you know, hope the check gets to you. But now you can actually, it looks like you can go in and say, if you want the stimulus check direct deposit, you can go into this website, put in your information, and it will process it that way instead of, you know, mailing it to you or mailing it to the wrong address or what have you.
Yeah. Again, for those who have high income, you know, 2020 is still a great time to plan ahead, because if you can lower your income this year, whether, you know, naturally because we have less income coming in, or strategically in terms of, you know, cost segregation and maximizing write-offs, you still could get the benefit of the credit. All right, let's go real quick into new extended tax deadlines.
Yeah, and as Aaron was saying at the beginning of this, obviously this is all accurate information as of today, because this is probably the third or fourth round of changes we've seen from the IRS in the last few weeks about different deadlines. So the current version is that all tax returns, all federal tax returns and payments that were originally due between April 1st and July 15th are extended until July 15th now. So that includes 1040s, that includes trusts, that includes 990s, if you're filing charitable trust tax returns, things of that nature. And also they've clarified that first and second quarter estimated tax payments are now due July 15th instead of April and June 15th.
How do we move this to the next slide? Oh, sorry. Go ahead.
And then also for you know, everyone who lives in California, California has kind of jumped on board with the IRS. So basically, in a nutshell, California, anything that was due April 15th is now extended to July 15th, and that includes payments for 2019 year, that includes prepayments for the 2020 year, so your $800 minimum taxes, your LLC gross receipts fees, anything that was kind of due in that window is now pushed back to July 15th.
Quick question.
Right, so
Quick
yes?
question. Usually in the state of California, you're paying the second and third quarters on the second quarter. Is that correct? So now are you paying all three?
Yeah, I think sorry, I'm trying to remember my head, but yes, there's a quarter that the California doesn't you typically impose, and I can't remember if it's second or third, but anything that was due April or June is now pushed back to July. So yeah, people are going to basically have kind of a laundry list of things to pay come July if they are, you know, paying past taxes for federal and state, and or paying estimated taxes for 2020 year for that matter.
Okay, thanks.
So similarly, IRA and the HSA health savings account contributions are also extended automatically until June 15. So the main thing here is you don't have to be, you know, impacted by coronavirus. This is just across the board for everyone. States, different states. I know we have different investors, landlords that are have properties out of state or flipping out of state. States still have their own separate deadlines, so make sure you double check. On the AICPA website, there is a link that they've summarized state by state. So I just looked at it this morning. It looks like the vast majority of the states are on board with this July 15th deadline, okay? But regardless, you know, just double check in case anything were to change.
Okay, another big question that's come up in the last few weeks is in regards to, you know, deadlines and extensions and stuff, is whether or not 1031 exchanges were going to be affected. And as of a couple of days ago, the IRS, when they came through this recent revenue procedure to further clarify the extensions and things, and now it does look like the 1031 exchanges are covered by that. So this is Notice 2020-23. Now, it doesn't specifically mention 1031 exchanges, but the consensus in the industry, and us talking to a few different 1031 exchange accommodators that we respect and have worked with a lot, is that the notice does cover it, because the notice talks about any person performing a time-sensitive action. And so a time-sensitive action would imply that if you have your 45-day window that fell between April 1st and July 14th or July 15th, that 45-day window has now been extended to July 15th. Or conversely, if you had your 180-day purchase deadline for a 1031 exchange was going to fall in that window of time, that has now been pushed back to July 15th. Now, one of the things that has not been clarified quite yet that I read about was, I guess just a quick example would be, is what if your 45-day deadline was April 15th? Okay, well, that's going to be pushed back to July 15th now. Well, 45 days is part of the 180 days, but what are they doing with the 180-day deadline now? Because that original deadline was going to fall outside of the July 15th window. As of right now, the word on the street is that that is not being extended on the back end. So it's kind of, does your 45-day window or your 180-day window fall right now between April 1st and July 15th? If so, it's been pushed back to July 15th, but that's all we know at this point in time. So hopefully that kind of makes sense. I think the same theory would go for opportunity zones if you are, getting up to the 180-day window for, replacing your investment in capital gains income. I think that can still qualify as well.
All right. And we're also going to touch on just more tax changes that are more relevant to real estate investors. There's quite a few tax changes, but for today's purpose, we're just speaking on the ones that are more relevant from a real estate investment perspective. So one of the big changes that came out was with respect to the treatment for net operating losses. Essentially, the government has made changes to allow people to use losses to essentially get money back into their pocket. So under the Tax Cuts and Jobs Act, net operating losses were no longer allowed to be carried back to claim a refund. Okay, so before we can only carry it forward. Now under the CARES Act, they basically got rid of that limitation for years starting with 2018 through 2020. So this means that if you had losses in 2018, 19, or 20, you can instead carry those losses back to the previous 5 years and then claim an immediate refund. Okay, so I guess an example might be a real estate investor or apartment owner who invested in some properties in 2019. Maybe they had a big tax loss as a result of depreciation or cost segregation. Instead of just carrying that loss to offset future income, you can now do a NOL carryback and then claim a refund for the taxes that were paid up to the previous 5 years. So, a way to kind of get money in your pocket now, rather than waiting to offset future taxes.
And as of a couple of years ago, when we could still carry losses back, you still want to do the same analysis with your CPA to figure out cost benefit. Does it make sense to carry the loss backwards? How much are you going to get back as a refund versus what do you think your income is going to be in the subsequent years, and what tax bracket are you going to be in the subsequent years to figure out where you're going to get your best bang for your buck. The other thing that I kind of read about this was, typically, let's go back to your 2018 return. You've already filed your 2018 return. You were carrying your loss forward, but now you want to carry it back because you're going to get a better refund. Typically, there's two different ways you can do that. The quickest way to do that is by filing a Form 1045. And generally, the 1045 has to be filed within 12 months of the end of the year that generated the loss. So we're talking about your 2018 calendar year. You would have to file the Form 1045 by December 31st, 2019. To get the quick refund, and usually the IRS has to process these quick refunds within like 45 to 60 days, something like that. A lot better than filing an amended return where they can take 3 to 4 months. The key takeaway here from the recent notice is that if you still want to use the Form 1045, they've extended the deadline from December 31st, 2019 to June 30th, 2020. If you're using that to change what you want to do with your 2018 loss. Obviously, 2019, you still have an opportunity to do that if you've filed or even not filed at this point in time. So.
Yeah, and another change on the net operating loss is under the Tax Cuts and Jobs Act, they limited the usage to only offset 80% of income. Now that's gone as well for 2018 to 2020, as well as carrybacks. You can offset up to 100% of taxable income. All right. Another one that, let me change the slide. Another big change that impacts real estate investors. This one mainly is for investors who are in the non-residential rental space. And essentially it made a correction in indicating that qualified improvement property that's done to a property is now considered 15-year asset. And the key benefit of that is it means that now those improvements are eligible for bonus depreciation. So example might be an investor who owns a medical building or office building who made improvements to that property in 2018, 19, 20 or even beyond, if you've already filed tax returns in the past for those improvements, you can potentially go back and do amended returns to now claim bonus depreciation. And for those types of properties, we generally see a fairly significant dollar amount when it comes to improvements. So probably a good opportunity for a lot of investors.
The reason why this is a big change is because before they updated this, the treatment of this was that you were writing these off over 39 years, evenly over 39 years. But now you are, instead of classifying as 39-year assets, you're classifying as 15-year, but then you're getting 100% first-year depreciation. So instead of writing off over 39 years, we're taking it in the first year. So obviously you can see where that can have a huge impact on people's tax returns.
Yeah, and in this, obviously this can be coupled with the net operating loss we just talked about. So take a bonus depreciation, create a bigger loss, go back and do amended returns, and then claim a refund for prior year taxes. So you can see the intent of the government trying to, get money back to the taxpayers sooner rather than later.
Another recent change has to do with what they were calling the excess business loss limitation. So under the Tax Cut and Jobs Act, they were essentially limiting somebody to claiming the most net loss you can claim from business activities that you're actively involved in, rental activities or real estate professional, things like that, was a combined $500,000 per year for a married couple, $250,000 for an individual. They've essentially done away with that cap on those, so that now if you are a real estate professional, you've got a substantial portfolio of rental properties, you do cost segregation, and if you generate $1 million net loss on your rental properties because of all the depreciation, you can deduct that $1 million in the current year, and then that can, again, help coincide hopefully with generate maybe a net operating loss that you can carry forward, things like that.
All right, so next let's talk about the Paycheck Protection Program. So this is part of the loan programs that came out under the SBA. And this is something, from a real estate perspective, definitely something to consider for those with active real estate income. So by active, generally, we're talking about flippers, wholesalers, syndicators, property managers, essentially any kind of real estate income where you are paying payroll or self-employment taxes on, okay? Because one of the requirements is you must have payroll or self-employment income. That's what the loan calculation is based on.
Yeah, and then this works for people with employees. Typically, obviously, we applied for this as well as our business. Keep in mind that the proceeds you get from the loan, they do need to be mostly used for payroll expenses. They are giving a cutoff at 75%, is at least 75% of the money to be used for payroll expenses, but you can also use it for mortgage interest, utilities, rent, certain other operational expenses. So you definitely want to keep track, work with your team of advisors on this, because this can be beneficial, and hopefully this will work out to and work out in everyone's benefit.
Yeah, essentially this is the government giving you a loan so that you can pay your employees. Now, unlike many limitations in the tax world, benefits are limited when it comes to the owners of the businesses. So this is one of those where it's not. So even if you are the sole employee in your business, you can potentially benefit from this forgivable loan. Okay, so question we're getting all the time, where to start applying for a bank. I'm sure everyone's going to talk about that. The other speakers will talk about that a little bit later too. But generally we're talking to clients about starting with your own bank. If your own bank is already set up for that, because banks are giving priority to their own clients and sometimes even priority to their own existing loan clients or lending clients. Something new that I read this today was that the IRS just came out with a new form to allow the fintech businesses to be approved to be a lender. So fintech meaning PayPal or Square, those kinds of companies can now apply to be lenders to help with the shortage. So we'll see if anyone gets the paychecks soon.
If you determine that your bank is not set up to do this for you, go to the SBA website, and you can do a map search, put in your zip code, and it'll provide you a list of approved SBA lenders in your area, and you can kind of pick from there as to which one you want to go through.
Oh, sorry. All right, and then the other one that's part of the same loan recovery. This is the economic injury disaster loan, also commonly referred to as the EIDL loan. So this is available for those with active real estate as well as landlords. Similarly to the one we talked about, to help to provide temporary loss of revenue. This one has, we forgot to mention on the previous loan, the interest rate was 1%. I'm sorry, was it? Yeah, it was 1%, 2 years. On the EIDL loan, it's 3.75% interest, 30-year term. Up to 10,000 of this may be free grant money. Okay, doesn't mean that's the cap. You can have a cap on a loan of higher than this, but only up to 10,000 could be forgiven. And one of the requirements in order for it to be forgiven is that it needs to be used for business operational expenses, similar to what we saw on the previous slide. So payroll, interest, things like that. Okay. All right, so what does it all mean? As you can see, there are a lot of new different opportunities for real estate investors that were not available before. So, you know, the details of these are ever evolving, which we've experienced, you know. So oftentimes things are being updated, you know, throughout the day even. So just make sure you keep in touch with your team, your CPA, your attorneys, your lenders, and make sure you know, maximize the benefit that you can have from these latest tax changes. All right. Did you want to take questions now or later?
Let's move to Kaaren. Let's loop her in and see if there's any updates. We just did an interview with her last weekend, so we might be able to take questions after we do a little bit of chatting, because one of the questions I'm getting most, and it may have changed, you and Amanda and I have been going back and forth, if you've got a self-directed IRA, are any of these programs available in it? And I sort of get the sense it's a maybe and we're not sure. Am I correct?
Yeah, you're exactly right. You know, in fact, I've been asking, you know, the non-recourse lenders. Now, this PPP loan is a non-recourse loan, right? And an IRA can take on a non-recourse loan, but you go and you look at the PPP application, and it doesn't say that an IRA is an eligible applicant. It says something like a KEO plan or something like that is, but not specifically a 401k. So we're just trying to get to the bottom of it. In fact, I just ran it up the flagpole, have some attorneys look at it, and I'll get you an answer when we have it. But the PPP is a business loan. It is non-recourse. One attorney said, yeah, he thinks that, you know, yeah, that should qualify, but I don't have a definite green light yet, but I'll definitely let you know.
But we might as well cover this now, because I end up blowing everybody's hopes and dreams whenever they call for a non-recourse hard money loan with me. They're like, what do you mean? It's tax-free. I'm like, no, you have a CPA that knows what they're doing and knows what you're about to do, and that, you know, you're going to be paying taxes pretty quickly on this. What's the tax rate for any profits triggered by a loan inside an IRA?
It's the same rate as the trust rate, and if Matt and Amanda were on, they could clarify, but I think it can go up to about 48, 49%, or 38, 39. It's high. It's very high, maybe 38, 39%, I think. It's way up.
That's a good answer. It's high.
I see that, sir. Yeah, great.
Most people stop right there and they're like, I didn't know that. I'm like, yeah, you just have to know what you're looking at and run the numbers to see if it makes sense. But what's interesting about this is some of it's forgiven. So if you are able to get this and $10,000 is possibly just forgiven, is that free money that ends up in my IRA?
TBD, man. We don't even know yet.
It's very interesting. So we'll stay on top of that as well. And Matt and Amanda, you guys are asking the same question. And are you getting a sense that this is possible? Are you recommending your clients?
Yeah, I think I agree with what Kaaren said earlier. You know, we haven't seen anything that says the IRA is not eligible, right? So, I mean, you know, all of these tax changes came out in a hurry. So I know that, you know, at some point they'll clarify it. I guess it doesn't hurt, you know, from a proactive perspective, it doesn't hurt to try to apply for a loan. If it comes out you're denied or it's not available, or even if you just don't like it, you don't have to take the loan. You're not forced to do it. But yeah, I had a client that asked me the same thing. You know, if I get a loan, I'm going to have to pay the UDFI taxes on it, but it's potentially $10,000 of free money. So as long as the tax rate's not 100%, I think you still might come out ahead. But yeah, that obviously, you know, hopefully we'll get some clarity on that in the next weeks or days.
regardless of where it ends up, I do like the idea. It was a suggestion by John Heyer. Talked about opening up a separate account and just being very diligent of what you're writing bills against on the money that was provided by this program. Just staying very organized. If you get audited, you have all the backup proof, and it's an easy way to segment the money to make sure, especially with the PPP loan where 75% has to go to payroll. It would just be really easy just to go, yep, here's a ledger for this account.
Now, just to clarify, on the PPP program, that's capable of being forgiven entirely. That's not $10,000. It's the entirety of it being forgiven. Is that correct?
Yeah, that's how it's written for sure.
Okay.
Yeah, so you have to use it for eligible expenses in a given time period, and if you meet the requirements, then it could all be forgiven. But yes, I like what you're saying about the keeping it different accounts, and I think the government's kind of set that up for us. In that when you apply for the loan, both the EIDL and the PPP, they do ask for banking information, right? So it should automatically be direct deposited into your business or entity bank account, so that money from there will be spent for business or real estate stuff. But yeah, you do have to be careful if you're applying as your individual, as a sole proprietor, and if you don't have a different bank account, then definitely consider having a separate account just to take that money.
Kaaren, are there any other updates that we should cover that we didn't talk about on last Friday?
I think we could just kind of go over it briefly if we have a couple minutes, because I think we might, if you don't mind.
Sure, of course.
I mean, Matt and Amanda already covered how the 990T was extended until July, so check that box. The RMD thing, I think every year if you're 70 and a half, you have to take an RMD. And also, if you have an inherited IRA, you have to take an RMD, but that's also that's totally waived for 2020. You're not going to have to make it up later on. It's just waived. So that can be a really great thing, because of course you get taxed on that RMD. But I think the one thing we got a call on it today, somebody was asking about the coronavirus related distribution, the CRD. Before you touch your retirement account, you want to be careful, because that's difficult money to replace. You've got these contribution limits. So you can't really put it back in. If you take a loan from your IRA, it's actually not a loan, it's a distribution, a taxable distribution. Penalties are waived, and you've got 3 years to realize the tax consequence on that. So that's great, but you're also stealing from your future self, if you do that. If you need it, you need it, but your retirement account is there for your future self and to help you with your retirement. So that is there, like coronavirus related distribution. If it's from a 401k, it's a loan. If it's from an IRA, it's a taxable distribution. You get 1099 on that. So if you really need the money and you're like, I really don't want to touch my retirement account, some of the things you can do is, check with your employer. Maybe you still have some PTO, sick pay, vacation time, something that you can tap into that, or this pandemic unemployment compensation, which is different from regular unemployment insurance. So tap into that, or unemployment insurance, either one. Or even if you've got a whole life policy, you've got some cash value, you can borrow from your whole life policy. Where you can take $1,000 out of your retirement account is enough.
Kaaren, one of the questions that came up is wondering if losses in an SDIRA will be considered.
No. That's a great question, and a lot of people are surprised by that. If your IRA does lose money, then it's not a write-off, and you just lose it. Actually, you have to prove that you lost it. You have to get a valuation on the asset to prove that it's, right, add insult to injury. But that's because the IRS wants to see that it's true and real, and so a third party will verify that. And we've got some low-cost valuators that we refer to our account holders. But no, you got to prove it.
I got a question. Does any of this apply to health savings accounts?
It does. It all does. Mm-hmm.
Okay.
Which part were you thinking?
Well, taking it and using it, it's not an interest for 3 years, or not a prepayment, or it's not a taxable event for 3 years. Is that accurate?
If you take the money out of an IRA or an HSA or something, then the money is penalty free. and you have 3 years to realize that tax consequence. So you talk to Matt and Amanda or your competent tax advisor,
Okay.
and you decide how you want to do that. Somebody asked me today, hey, look, I'm going to have really low income this year, so I'd like to just go ahead and pay it all this year since I'll be in a lower tax bracket. Next year, my tax bracket will go up. I said, well, hey, talk to your tax person. Maybe you can do that. Just pay it all off straight up and at a lower rate.
This is a good question for you. The question is, how long does it take to get a loan from a 401k? And the last time I experienced this as an administrator for a defined benefit program, I was sent to the expert. It wasn't your company, just to be clear. I was sent to the expert who had been at the company for 2 weeks. And I was telling them things, and the attorney that I was working with that we had hired, I knew more than both of them combined. I don't know.
Why am I not surprised?
Yeah, so maybe talk about that process and what that looks like.
Sure. Well, if you already have a solo 401k with uDirect, it's a pretty simple process. In your plan binder, you already have a loan document. Yeah, just make a copy of it so you can keep the template, and you fill out a loan, you fill out the application, and it takes about 24 to 48 hours to process that. Then you need to pay it back to your IRA within 5 years at the IRS published rate. And we were talking about this the other day, so I looked it up. And there isn't really a published rate, but what the general word, like rule of thumb is it's prime plus 2% is a fair rate.
Okay. Let me see. I'm trying to answer some questions that I can. Let's see, Matt and Amanda, just so you know, well, we've got 4 minutes in this segment. Did you want to cover anything else, Kaaren, or can we jump around?
I think we can jump around because I really wanted to touch on what's new. Matt and Amanda talked about the new contribution limits and the extensions. So that's great. That's what's new in the IRA world.
Okay. And again, we taped a half-an-hour session just with self-directed IRAs on, what was that, the 10th?
Friday, yeah.
The 10th, yeah.
Friday the 10th.
We'll link to that when we come out because this is just sort of meant to be a quick update. If you can prove the loss was due to mismanagement fraud by an operator, does that change the loss rules inside a self-directed IRA? Kaaren?
Yeah, no idea. And so, but management, no, a loss is a loss, and so I don't think it changes it. I've never seen any way, Matt and Amanda, you can answer, but no way that a loss is ever deductible, regardless of the reason.
And all those expenses, attorney expenses, have to originate from inside the account. So
that's right. All the expenses are paid for by the IRA. That's right. No, it's bad news. I mean, you have to be super careful going in.
Yeah, I think the reason that is because for most pre-tax money, you take the deduction, you already took the deduction when you funded the account. So if I'm making a 50,000 contribution, I already deducted it this year. So later on, 2 years later, if I lose the money, whether it's due to mismanagement or fraud or just bad investment decision, generally the IRS doesn't allow you to double dip by claiming yet another $50,000 loss on the write-off. So yeah, unfortunately that's the case, but it kind of makes sense when you think about the fact that it's already deducted previously.
Insult to injury, I didn't know you had to get an appraisal. And because honestly, depending on what asset you're holding, as an example, a note appraisal is no joke. It's not like a $375 ordeal. You have to get somebody who specializes in note appraisal. It can be very expensive.
It could be. We've got an evaluator we've used I've been using for about 12 years, and they charge around $600 to do that, to appraise a note. What you're looking at is what's the principal value, what's the unpaid principal balance, what is it performing or not performing, and then they take a little bit off for the marketability of the asset, and they come up with a value. So yeah, evaluators that we've got will charge under $1,000 for that kind of valuation.
We do that about every 30 minutes at the Norris Group for free.
Yeah, exactly.
We could kick up our rates.
You know what? I think I might be able to answer a few of these questions all in one swoop. The grant status, at what point is the PPP and the EIDL loan, have we gotten any clarification on when the federal government is going to be like, you're adorable, you get this money for free? And who's going to be picking and who makes that decision and how? Is there any clarity on that?
You mean how the loan will be forgiven?
Yeah,
No,
whether it's the $10,000
forgiven or approved.
Approved first, but we get it, and so like the EIDL, $10,000 can be forgiven, And then on the PPP loan, there's a chance that the entire amount could possibly be forgiven.
Yeah, there's no information yet on how do you substantiate the money that you've spent, what kind of application that will be. So I know that's something the AICPA is working on. They're trying to get some kind of uniform list or something from Treasury to say, okay, here's, once you get the money, here's a list of things that would be needed to show how the money was spent. I imagine it's going to be, same as what you would normally do in terms of filing tax returns, having receipts and showing what funds, how much was paid for what activities. But yeah, nothing definitive yet on exactly how you apply for the forgiveness portion.
Okay. Well, we're going to move on if that's okay. And if you guys are hanging out, I'll save some of the questions that came up because we do have good ones, but we're going to try to stay on track if that's okay. So thank you.
Thank you so much.
Thank you, guys.
Mr. Paul Herrera is the Government Relations and Communications Head for the Inland Valley Association of Realtors and several others. What we try to do is sort of jump around in different areas, and we wanted Paul to come on because he's got a very unique angle. He and I were on the phone, what was that, a couple weeks ago, talking to our one of the electeds in the city of Riverside, trying to stop them from making bad decisions. And then Gavin Newsom's order came up, actually solving some of the things that we were asking them not to do. So that was good. Hi. Thank you for coming on.
And Aaron, how you doing?
Good.
Can you hear me?
Yep, can hear you just fine.
Yeah, okay. I've been on a lot of those phone calls over the last few weeks, including one this morning. So they just keep coming around. So my part of the program here is to cover legislation and issues that we're tracking. So I'll start here. When it comes to the regular course of legislation, there really isn't any, other than at the federal level where the relief legislation is moving forward. In fact, you've got the 3 pieces that have already passed and a 4th piece that's negotiations that we'll see where that goes. But the normal course of business has pretty well shut down at this point. California's legislature is out of session. They initially planned to come back on, I think, the 15th of April. That's not going to happen, obviously. They've put the return date now to first week of May, and it's really hard to imagine how they get there because they can't come back into the building and hold hearings in private. They have to open the building to the public. You have to have.
Hey, Paul, you're breaking up a little bit. I don't know how to make the sound a little bit better. I don't know if your mic is a little bit too far away or what. I don't know.
No, I'm using a earpiece on my phone.
Okay, it sounded a little bit better. Okay, sorry.
Okay. Yeah, I'm not sure. I'm on the phone actually to try to make sure I had a better connection. So hopefully it stays intact. So there isn't regular legislation. We expect that the legislature is going to have to find a way to come back into session in May because they have to pass the budget. They have the May revise that's coming up. And this is where we'll start to figure out just how bad the damage is on the state budgets, and we'll start learning what the impact will be at the local level. That's going to be a huge issue. So let me start with some things that we are tracking that are not directly COVID related. There is still qualified for the November ballot a split rule initiative that would remove Prop 13 protections from commercial real estate in the state of California. I just can't imagine a world in which California voters approve this. After seeing California voters reject Prop 13, this is the Prop 13. This is the school tax bond, school bond that was on the March ballot. I just don't see how voters are going to then come around to approving a $9 to $13 billion tax increase on small business, who are now being hammered by coronavirus. They're not going to be in a position to pay it. This is one of those blood from a stone situations. Once you get down to the votes in November, assuming they even get to the ballot in November at this point, they have qualified. They can move forward, but I don't see how they're going to find favorable polling to actually pass that. I've tracked a couple other things around the state. One of them was I looked at the local results of that Prop 13 failure. That was the $15 billion school bond. And what I noticed was it was a bipartisan rejection of that bond, which was very surprising. The state has been very friendly to new borrowing for everything from infrastructure to schools, definitely. And the fact that it didn't pass in a single city of San Diego County, to give you an example, including cities where you have a 2-to-1 Democrat-Republican advantage in terms of voter registration. So you see that it's not a partisan issue. It is the state getting voters in the state getting a lot more skeptical about spending and about taxation. Then you see some tax increases that were proposed at the local level. CAIPA had a house and sales tax measure. There were several around the region. There were school bonds. There was a secondary college school bond in this area. Almost all of them failed by a 2-to-1 margin. Some were within a few points of 2-to-1 margin. These are situations that we just haven't seen the last couple of years. The electorate has changed, even though the makeup of the electorate in terms of partisanship has shifted the other way. You would expect them to be friendlier to some of these initiatives, and they have not. There were some things we were working on.
Hey, Paul, we're getting a lot of feedback that people can't hear you. Can you go off the Bluetooth? Can you just connect to your phone directly? Can we try that?
I'm sorry?
Can you connect to without the Bluetooth?
Let me try the computer audio.
Okay.
Yeah. Yep, I'm going to do that.
Okay. And just a recap of if you weren't able to hear some of what he was saying, he was talking about the election that just happened, and on a 2-to-1 margin, very bipartisan. A lot of the bills, at least in Riverside, school bonds and fees and whatnot, everything failed. So the split roll tax for property taxes on a Prop 13 change would be unlikely to pass if they decided to move forward. So are you able to, the computer audio?
All right, how's that?
A lot better.
Okay, I switched off the phone and went to the computer.
Way better.
Way better.
Okay, I am having a little trouble hearing you, by the way.
Okay.
So, but if you guys can hear me, that at least is an improvement on this end. So I was talking about voters rejecting new spending even before all this happened, and I'm very skeptical that the split roll initiative scheduled for the November ballot really has a chance of going anywhere at this stage. And I felt that way before COVID because of the school bond results statewide. We were working on some legislation that was going to have an impact on our industry. For instance, trying to reform fire insurance in vulnerable communities around California. That's been an issue we've been working on with the insurance commissioner over the past several months. And there was actually legislation that was introduced in February that was heading towards its first hearing at the end of March. That didn't happen. That, along with secret reform options that we're starting to get pretty excited about, that could have opened up the pathways to new housing construction. The legislature was finally starting to take seriously the supply approach to housing affordability around the state. We were starting to see some real conversations around this, and all of that's been shut down along with the legislature by what's happened. It's hard to imagine that any of those really come back onto the discussion table in this legislative year. We're looking at really 2021 before it comes back, and we'll see what kind of shape the state budget's in, local budgets are in. But nobody wants to make a commitment that in any way impacts state resources or local resources at a time when the ground's still shaking. We can't even assess the damage of what's happened out there, much less start to determine where the resources will be for future lawmaking. It's just a tough position. So it's not legislation that we're really tracking, it's emergency orders. You know about the governor's eviction moratorium, you mentioned it briefly. That's really the least of our concerns at this point, because the State Judicial Council then followed up last week with one of the most sweeping orders that we've ever seen, and one that I'm quite concerned about, actually. If you didn't follow it, State Judicial Council essentially locked landlords out of the court system. It said that they would not allow courts to issue any new summons or allow the filing of any new eviction procedures for at least 90 days after the emergency order from the state has been lifted. The emergency order is scheduled to go on right now until the end of May. So this, assuming it doesn't get extended. So the Judicial Council order now moves that to the end of August, when the first eviction proceedings could begin. And now you're looking at a severely backed up judicial system that who knows how long it's going to take for that to really function. So the timeline for an eviction and the time in which people may have the opportunity to not have to pay anything, for landlords to not recover rents, could be easily 8 to 10 months, more realistically closer to a year plus, depending on how long it takes to rebuild, come off of that backlog. And that's something we really don't know what the ultimate impact will be on the state of California investors and their ability to hold on that long. Small landlords will hold a few months reserve if they're responsible, 3, 4, 5 months if they're very responsible. At the higher end of that, nobody holds a year. Nobody has that kind of expectation of just being unable to do business. And this is where, Aaron, you and I have had these conversations with the Riverside about the need for landlords and tenants to work together, communicate with one another, communicate with the government, and try to find solutions that recognize that we're all in a very difficult situation together, and not have this, us against them mentality. Unfortunately, that's still, that's not being reflected in the lawmaking and in the emergency orders that are taking place. So you have the state judicial council action, and that has really overshadowed any kind of local action, including what you and I discussed in Riverside or in Corona. Los Angeles is the only one that has a more aggressive version with a 12-month repayment period that they created. But even then, given the lockout from the court system, even that 12-month repayment may not mean all that much, because it assumes that during the time after the emergency order, people are still making their regular rent, even if they're having trouble making up the lost rent from the previous time. So it's hard to see how any of the local orders are in any way more aggressive than what the state's done to the court system and outside of the regular legislative process. We are looking at some cities that are considering rent increase moratoriums. I was in a conversation on that this morning. There's a few cities in the Inland Empire who have never before discussed in any serious fashion rent control that are looking at these as an emergency measure. And for the most part, the message for them have been, they're not very impactful. Landlords aren't raising rents right now. It's not really an area of focus. So it's more symbolic than anything else. And what we've seen is there's a few folks out there who have long-term ideas of how they want to change the landlord-tenant relationship. And this becomes an opportunity in which to start to enact long-term plans. And what we want is to not see this used as an opportunity to change the landscape long-term in ways that wouldn't have happened if it wasn't for the situation. So I'm watching that very, very closely. And honestly, a little bit resentful of opportunism where I've seen it in a couple of places, and it's creating challenges that shouldn't be here right now. As an organization, we're giving really maximum flexibility working with local and state governments on how to address the crisis that's at hand, so that we have tools to work through this time being, while trying to look at safeguards for the long term that allows us to come back to a somewhat reasonable place. This is still California, and it's not like it was a friendly environment to be an investor of residential property before this all happened. So that's what I'm really keeping an eye on. And then long term being not that long term, 6 months from now, budgets. Starting with a May revise in Sacramento at the end of next month, then as cities and counties start to see what's happening. We've never seen an issue hit the economy in real time like this one, at least not in recent years, not in my lifetime. And that's going to, usually local governments and county governments and state governments, there's kind of there's a little bit of a delayed reaction before they start to get hit in their budget. And so they're safe for the fiscal year, and then it starts to impact the following year a little bit. And then year 2, 3, after that slowdown, they start seeing the real impacts and the heavy duty lifting. And even after the economy's recovering, they're dealing with tax collections based on the really bad years. In this case, it's happening in real time. Sales aren't happening. Restaurants aren't operating. You're not seeing tax collected by hotels. and being remitted back to counties and cities. The only thing that is holding shape at all is property taxes, because those are built off of assessments that were completed back in August of last year. But even then, there's going to be an issue with collections, and there's been some discussion about creating some form of property tax holiday as people, again, in real time, deal with the fact that they don't have any money in which to use to pay for these things. The federal government can print money at will, and so they can pass a $2 trillion spending measure like they just did without having any ability to back it up with tax collections and pay for it. The state and local can't do that. They have to balance on a yearly basis. So the state had a $21 billion budget surplus when this started. Hard to imagine any of that survives this situation. At the county levels, some counties like Riverside County were already facing draconian cuts in the next couple of years because of pension obligations made 20 years ago that are coming due now. And in a good economy, they were going to have trouble making ends meet. Now we have this. So
I'll point out really quick too that you've got the double whammy of the stock market going down, which affects pension funds. However, I know that cities are applying for the PPP program. Is there any talk about as part of the payroll, the pension funds getting rolled up in that, because that's one of the expenses that can be allowed for, that they leverage that to sort of plug these gaps? Because if the stock market stays down and it crashes, they're in a huge world of hurt.
The fourth round of relief at the federal level is likely to, at least we're going to argue for relief for local governments and some state governments. The question is just how much of a burden can the federal deficit take? And right now it seems to be unlimited, but there are limits to some of this borrowing, and certainly limits to the political will to keep writing trillion-dollar promises into the future. And state governments are going to be so impacted, local governments so impacted, that it's just hard to imagine they can fill in all the gap. They're going to be able to get through this fiscal year, but beyond that, we're going to be looking at cutting some serious tissue and bone at the local level. And I don't know, unless we see a quick bounce back, some kind of V-shaped recovery that allows us to get to a place where things start to level out, I just don't see how we avoid serious pain and in a very short time frame that we normally don't see with government spending at the local and state level. So yeah, they can do things to try to, to level off some of the worst of it on the short term. But this next fiscal year is going to be extraordinarily painful. And where do they get the money? I don't know. I don't think taxpayers are going to want to see tax increases. And when it comes to increasing taxes on businesses like the split roll initiative, blood from a stone starts to become a phrase that is going to get tossed around quite a bit. So it's going to be very, very, very challenging, and people are going to be looking for money just to keep some basic services going. Okay.
We need to move on to Mr. David Granzella up in NorCal. Dad, did you look like you have a question?
I just wanted to ask, was there any thought from the Fed to expand Section 8?
At this level, I don't see yes, I mean, there's thoughts by some people in the federal government, but not enough to actually make it policy, certainly not in this legislative year.
Okay.
Next year, depending on what happens in November elections, who knows? That could shift.
Okay.
But not right now.
Okay. Thank you, Paul.
All right. Well, if you can hang out, if we got questions, have a nice glass of wine and we'll chat a little bit.
Okay. Thanks, Eric.
All right, David Granzella is up. David, I'm going to focus on I'm going to send this over to you. David is the CEO of the NorcalREIA up in Sacramento. David, welcome.
Thank you very much for hosting this.
Welcome. All right.
Let me start off with something. I'm sorry, go ahead.
Go ahead. Did you get this? You got the screen?
I got the screen.
Awesome. There you go. I see it now.
Okay. Let me, well, first of all, let me start up with some positive, hold on. I flip that over. There we go. Let me start off with something positive. I was talking to one of my friends who's a property manager, manages about 1,200 units in Sacramento and Placer County, Chris Arola with Rent Pros, and he manages some of my properties. And as we spoke today, and as of right now, this part of April, 96.4% of the rents are all paid up.
That's great.
So we don't know what's going to happen in May, but somehow everything's been falling into place for them. And in regards to my my personal multi-units that I manage myself, 100% of those rents that are in. So we'll have to see what happens. And I was thinking today that I usually give a gift card during the holiday season and so forth for Wally Mart. And I thought now might be a good time to extend that one more time.
Very good idea.
So let me touch on a few things before I get in the presentation. Bottom line is we all know absolutely everything's changed. Most of the buyers up here in Sacramento, Placer County, Northern California, kind of are in retreat mode, if not pause at least. Sellers are backing away. As of the last 6 weeks, 1,005 properties have canceled or put it on hold. I refer to that as pause. It's just a peak uncertainty. Sellers and buyers are backing away. It's a subdued market. Uncertainty and retreating seems to be the most prevalent words I hear when I talk to people. Unemployment's huge, we all know. Lenders' uncertainty. One of the interesting things I found out that as of March 20th, 43% of the current offers had multiple offers as of March 20th. So that was also some positive news. Moving over to the presentation. Let me hit this. There we go. Okay, here's this. Can you guys see the picture?
Yep, see great.
Perfect, thank you. Story goes, the first week of March, 714 listings. Going down quickly, as we can see, down to April 5th through 11th, 76. The pending sales, as you can see, took quite a toll. Also, which is expected. One thing I noticed that today on this presentation is it went up from the 4th of April to the 11th of April. It went up 20 units, which I don't know if it's neither here nor there because I think we're in the middle of we don't know what. So that's more or less, as far as I can see, a hiccup. Canceled, as you can see, were exponential in the middle of March. And what the new thing we have is called hold. I call it pause. We've lost a lot of properties into pause, and we don't know where they're going to be, whether they're coming back in the market, whether they're having problem getting appraisals, lending, or just plain old fear. I'm guessing a huge percentage of that is just related to fear. Regarding the stats on the new listings, 33%, minus 33% the first week of March. In regards to the pendings, minus 40% since the first week of March. There's been 460 canceled, 462 since March 12th. And on hold, 543. And for Sacramento, that's a lot of units. New listings this year is shaping up, was shaping up quite nicely. As you can see, we look at March, and it was picking up. April, we can't say much about, only for the fact is it's still early, so we're not going to touch on that. And here's a chart regarding what it looks like for the new listing 2019 versus 2020. Dramatic change. Here's another one I was picking up on, the canceled listings. 462 listings have been canceled since March 12th. As you can see by the chart, that's just huge. And we don't, is it people backing off, people pulling off, people having second guessing? I'm guessing, you talk to people and everybody's scared. They're walking away, they're putting it on hold. And also one of the things I've talked to a lot of people, they don't know where they're going to go if and when they do close on their house. Seems like a unique situation now where we're going to go. So many properties being pulled.
Oh, David, what's a huge thing about this inventory is that it's individuals making decisions in their best interest. If this quantity was lender owned, it wouldn't be canceled. The price would just be lowered, and they'd lower it until they got a yes. So this is a big deal. The inventory mix is a big safety factor for this market.
Oh, very good point. Exactly. And people are not in the position probably to actually lower. And as I shared with you earlier, people don't know where they're going to go. So we do sell our house. We do get what we want for it because it was fairly priced, or we can get rid of it or lower the price. Where are we going to go?
Mm-hmm.
That leaves them for that one more time uncertainty. And the pendings, as you see, have declined. Again, it's still early for April, but we all know there's going to be a huge decline in the pendings. Recent pending sales in Sacramento started out in March, 612, and steadily declined. I know, I don't know what to say. I'm looking at it, it's like,
Yeah, you think that was over 10 years, not 2 days, not 2 months.
these charts that I was reviewing, Bruce, remind me of the charts you often show that start back in the 70s and come up to current today.
Yeah.
The way they plummet. But this is a matter of months.
Wow.
And just to review this one more time, we've lost 33% of new listings in the past 6 weeks and 40% of the pendings. That's a huge aspect of the market. Also, if anybody wants these presentations, they can go to NorcalREIA under free resources. I want to thank Ryan Lundquist and Joel Wright for their statistics. They've been a great resource. And there's a lot under free resources. There's a lot of other information.
Thanks, David. You guys had Zillow and Open Door as far as the iBuyers that have backed out of California, and I know I have real estate investors who leverage them quite often as a place to
yes.
their deals, and I know they're not very they're gone. Have you gotten any sense from some of your members if they're excited about this in the Sacramento area? If you've got Bay Area people coming out your way, any sense of what's going on?
My biggest sense is people are freezing. People are in pause or hold mode. By the way, we're investors, so if something comes out and it's a screaming deal you can't pass up, you can't pass it up. And for me, loving multi-units especially. But it's kind of like the old days of catching a falling knife. What do you do with it if you get it? It's got to be a really good deal.
Is it a calm pause in motion, or is it a really tense pause in motion? I'm just curious about what the mood is.
I would say tense and almost paralyzing because people don't know what to do. People are not. People are putting their hands up and putting back, and they're not running, retreating. But there's definitely a huge anxiety of not knowing what's going on and how long. Certain people that have been able to cushion themselves for something of this nature. Sean O'Toole mentioned a long time ago, as a lot of other people have, are the black swan. And those who were kind of prepared for the black swan, nobody had any idea this was going to happen, but being prepared financially versus, as we all know, a lot of people can't afford a $500 car repair. It's a different level of anxiety from beginning to end through that spectrum. And in the middle is your average Joe trying to sell a house and trying to buy a house. Yeah,
not only is it the $500 expense they can't. No one really anticipated having 18 million people unemployed in 3 weeks. I mean, that's a shocker. Plus the business owners closing restaurants and all that by no choice of their own. So yeah, this is a very, very unusual, once in a lifetime event.
Sacramento reminds me a lot of the Inland Empire area as far as price point. So you're going to have a lot of renters along the coastal regions and the Bay Area that simply don't qualify under some of the IRS guidelines to get some of the help that's coming out, sort of like the $1,200. But, if you make $99,000 in the Bay Area, you're practically poor. You're renting a tent ADU in the back of on the roof or something.
Yeah, but you're only paying $4,800 a month for it.
Exactly. So, I mean, in the Sacramento area, landlords can, they can sort of say, oh, well, I know you're going to get this federal assistance and know that to be fact, where if you've got rentals in the Bay Area, it's probably going to be a little bit more uncomfortable, the same as it is in cities like New York City or Chicago right now. It's just not going to put a big dent in some of those really large overhead cities.
I think you're right. I think in regards to the Bay Area prices, as always, there's huge losses. These people have been put on hold. They're making a couple $100,000 a year. It's going to be a big transition for them, whether the renters or owners. What's going to happen?
Yeah, some of those tenants, even that make good money, just those federal checks will not be landing in their accounts.
Right.
So
no,
it's going to be a snake.
Even if it is, it's not enough to do anything.
Yeah.
A car payment.
Exactly. Wow. Okay. Anything else you'd like to cover last minute?
No, I'd love to hear from Bruce towards the end where he thinks the puck's going to land. Kind of like that Wayne Gretzky. I'm just curious. You know, this is inevitable. We've all been waiting for a change in the real estate market. This certainly wasn't what I expected, but at the same time, I'm curious where you guys think this is going to go.
Okay, yeah, I'm sure we'll wrap up with some comments about that. I'm enjoying the input from everybody, and it kind of is, you know, I have my own opinion, but that's why I'm listening to very smart people, so I can say, okay, well, maybe that changes what I thought.
All right, now we're going to come all the way down south and all the way west. Lisa Hoegler, she's the CEO of LA South REIA. Good evening.
Good evening. Thank you so much for having me on this. I really appreciate it. And quick shout out to LA South REIA members who might be listening tonight as well. Aaron mentioned I'm Lisa Hoegler with the LA South REIA. We're based out of the Torrance area, so we're in South LA. Most of our members are live somewhere in the LA area, most of them south of LAX, and our market really the investors that we support are all the way through Long Beach and, you know, and actually very far north too. Some even come from the Valley. So kind of a wide, diverse group of investors that we work with. But I'm here to talk a little bit about the South Bay and what's going on in parts of LA. LA is such an interesting socioeconomic, geographic area all over the place. We've got a little bit of everything. So tonight I want to touch on the quick health update in our area. I'm going to talk a little bit about some of the economic statistics we're seeing here as well, and the local impacts, of course, to the housing market. I've got a couple resources to share with you also, and then if we have time, I'll throw out some of my thoughts at the end as well. But as of today, LA County itself has about 9,000 cases of coronavirus and about 300 deaths. I only mention that because we're about 40% of the overall case count in the state of California. We obviously haven't reached our peak. Everybody's hearing this on the news, and they expect, at least in our local area, based on all the medical workers I've talked to recently, that we'll probably hit that peak in about another week. So Aaron's comment that the mayor of LA extended our stay in place guidelines through May 15th makes all sense in the world based on kind of where we are in the cycle of things. But it does seem like we're flattening the curve, and we'll all have to stay indoors a little bit longer here. With respect to economic updates in our area, we'll start out with unemployment, and I don't have the charts that David does, but imagine his, because ours are very, very similar. Our area has definitely seen a toll in unemployment, just like many areas of the country have. We know that there are over 1 million unemployment claims filed just in LA County alone, and obviously the numbers of those are planning to increase dramatically. Most of that hitting are young, lower wage workers, and most of those living in the city of LA or in the highly densely populated areas. We've got a whole bunch of them in the South Bay, some of those communities in the South Bay as well. Carson, Compton, Hawthorne, and parts of Long Beach and San Pedro would also fall in there. So right along the coast, we don't expect as much unemployment to occur, but based on the information that I've been reading and all the research I've been doing, it won't necessarily be the same story for all of the communities that are maybe 5 miles off the coast. We are primarily, obviously, a service economy. So the hardest hit employment, I guess unemployment claims in our area obviously have been what most are. It's going to be entertainment, hospitality, travel, and the restaurant industry, with retail right behind them. There are sources that predicted that up to 47% of jobs in the LA County area could potentially be at risk during this coronavirus epidemic and beyond, wow, which is a staggering number when you think about it. And that came from 2 different sources. One was 43 and one was 47. So incredibly staggering numbers. Again, most of that hitting the lower income areas in the LA area, not so much the beach cities and beach communities. We have not heard of any large scale announcements for work furloughs from any locally based companies, although of course we're hearing a lot of retail, TJ Maxx and Macy's and all those furloughs from large nationally based companies, but nothing locally. We don't have a lot of manufacturing or whatnot in our area, so it would make sense that we're not seeing that in any large scale. So the good news is there aren't key employers that are laying off dramatically right now, which could help, but it's just a makeup. I think the unemployment for our area is going to be a makeup of the small businesses, mom and pops, the gig workers, entertainment, and things like that. So I think it's a particularly volatile area, and that'll lead to a lot of opportunity, definitely in some of those less affluent areas. Regarding real estate, I have some information from Reports on Housing, which was looking at, this report came out on April 2nd, and it was looking back to the previous 2 weeks prior to that. So it's a 2-week comparison, and then also a year-over-year comparison as well. Our listings, the listings in our area in LA County were mainly flat to the prior 2 weeks. So not a lot of difference in brand new listings, but year over year, they were down 33%. So right in line with what David just shared in his area as well. And new escrows were down 31% in the prior 2 weeks and 35% versus last year. So a year over year change of 35%. So the big difference, obviously, year over year is all coming within the last couple of weeks. So the buyers and sellers getting nervous here. Canceled listings are 40% as well. We're seeing that, or I think David called it paused or on hold. I'm going to call it canceled, all about the same boat. It's roughly at 40% too. So far, I think because it's still too new in the cycle, we're not seeing a noticeable change in sales prices yet. And from just empirical conversations with people, I'm also seeing that there's no intention, at least in the short run, to do anything to lower prices or be aggressive in that respect at all. All of this just points to high reluctance and concern and uncertainty, like David said, on both the side of the buyer and the seller. The good news, I think, out there is in our market area, the supply is still relatively low. It was low going into this, and that might put us in a more positive position to rebound on the way out, but time will tell what actually happens. I think it's way too early in the process to know very much at all. On the multifamily and rental front, we already mentioned that there is going to be we've got the eviction moratoriums that are going on, and I think what Paul just mentioned is that in the city of LA, Mayor Garcetti indicated that as soon as the emergency is lifted, our tenants would have the option to repay that, those months of non-payment over the next 12 months. Obviously, there's some pluses and minuses to that, because Lord knows how that's going to line up with the forbearance timelines that the banks are offering to landlords as well. So that could be a concern. That is not ubiquitous, though. I think we've still, Long Beach and many of the other communities in our area are still at that 6-month payback plan. And the city of LA only moved to the 12-month repay plan based on a city council vote that occurred recently. So I suspect that some of the other communities will come along shortly as well to extend that 6-month repayment to 12 months as well. Another just small factor, I don't know that it applies to too many other areas, but the city of LA has also halted rental rate increase on RSO properties. Those were our rent controlled properties that were in LA even prior to last year, and that happened on March 30th. And I assume that other cities that might be in the same position will qualify, although we're not seeing huge rent increases across the board. David said that rents in the area, I think he mentioned that rents in his area from his conversation with his property manager, that most had been paid. I think you mentioned 96%. And Aaron, you also mentioned that you were receiving all your payments as well. Everyone I've talked to has said the exact same thing. Their rentals, their rent payments came in without a hitch. So obviously, that might be a factor of where I am in the beach communities, not representing a lot of property owners that are maybe inner city, but we are also not seeing the issues with the 30% non-payment of rent. So I don't know where that's affecting, but I'm sure next month will be worse wherever those are, and we may see some more cracks in the system also. We have many investors in our area who are involved in the short-term rental market, and although we aren't facing any kind of local constraints on that, obviously those units are primarily empty unless there's medical workers staying in them, but for the most part, those guys are having a really difficult time right now across the board. And then LA South REIA has a lot of note buyers as well, so I'm just mentioning this for our area. We expect, obviously, there's going to be a lot of opportunities in that space, but right now nobody really knows how the banks are going to be dealing with all of the delinquencies. So until that, we've just kind of got that on the back burner until possibly next year. I've spoken with a lot of realtors and brokers in our area, and essentially it's quite an interesting conversation. The South Bay realtors are not concerned. They believe that this V is going to be really quick, that they'll be back into business as usual in 3 to 4 months. I know, although this is in 2008, that they were not as impacted along the coast as some of the other areas were, and they're expecting this to be over and done with in no time flat. I'm not quite that optimistic by any stretch of the imagination, but that's what I'm hearing on the street. They do expect it, because people have been hesitant right now to list, that there'll be a surge of properties pushed onto the market as soon as we are allowed to go outside. And I think just from how showings are being conducted and things are happening right now, real estate is still going on. The people who are in escrow, what I've been told is that a lot of them they have to sell, or people have to buy. So the people are committed to their escrow. Things are moving along very well. So business is still being done. In most areas, showings are still occurring, although the protocols are changing daily. So nobody seems to know on a day-to-day basis and city to city what the protocols are. So it's basically a Google search of the day will tell you what you can and can't do. I just want to mention a couple of quick resources as we go along here. And I love the resource page that you put up, Aaron, at the Norris Group for all the coronavirus resources. It is tremendous. And for those of you who haven't gone out and taken a look at it, it's a big shout out for it because it's very well done. I also want to mention that the LA County and the city of LA has a partnership with LA County to help small business owners who are needing help with applying for the SBA loans. And to get help for that, you can Google LA CARES, C-A-R-E-S, CORE, C-O-R-P-S. And there's actually tons of people standing by to help you fill out your applications if you're in the LA area to figure out how to navigate this whole loan situation. I do want to mention one other resource as well, which is the City of LA Small Business. The City of LA has a small business emergency microloan available, and that is through the mayor's office. It's up to $20,000. You can go to lamayor.org/loan. So those are a couple of resources that are available for you as well. I don't know, my final thoughts here, because I'm running out of time, are that I obviously probably agree with everybody else on the call. I don't see any way of escaping any kind of recession, especially in the LA area. I think there will be definitely some dramatic impact to our local market. I think I personally have been happy to see the response of the speed of action that the government's taken with some of the stimulus and things like that have been positioned, but it's all going to come down to how the execution happens, in my opinion. And I think until we know more about the execution of how this money gets into the hands of the people, it's yet to be determined what will actually happen. I tell the investors in my group that, when you jump out of a plane and your parachute doesn't open, the free fall doesn't kill you, but the splat does. In this economic situation, we've got the opposite going on. The free fall will kill us, but once we can splat, the sooner we can splat, the better we can rebound and come up for air. So the question in all of this for me is going to be, how long is that free fall? And how slippery will that slope be on the way down? I think Main Street's going to wind up taking the brunt of this, of course. And but the nice part is I do see everybody pulling in the same direction. Let's hope liquidity stays intact, and let's hope from an investor perspective that people are building their reserves and getting their liquidity lined up. But other than that, I'm curious to see how it all unfolds.
Excellent. Well, thank you so much, man. Right on time. Right?
Yeah,
Got a
Lisa.
TV background? My goodness. You're amazing. All right. Well, are you going to be able to hang on the line as well?
Sure.
Okay, great. Okay. With that, we're going to head over to Christina Suter, CEO of Ground Level Consulting, as well as the president of Pasadena FIBI. Hi, Christina.
Hi, everybody. You can hear me okay, Aaron?
I can hear you great.
I thought we were going to get a wedding dress or something.
Great. Hey, I only save those for your events, Aaron, Bruce. You know, I mean, you said black tie, right? You know, formal event, that's what you get. You get a formal dress. There we go. I think that's a little better. It's all right, Bruce. I would wear a nightgown all the way to a wedding dress for you. How's that sound?
I'm hoping you get to do that
on September 18th as I
September
Survive
18th.
Real Estate.
That's
yeah.
our intention. Yep.
I know. I've got an idea. How about next time we do I Survived, you describe it as a pajama party?
Most investors will rejoice if we did that for sure.
That's funny. That might make for a better turnout. I don't know.
I don't know. But Lisa, that was an amazing. I loved her summary, and Lisa and I touched base earlier today to make sure we didn't talk about the same things, and Lisa covered it beautifully. So I'm gonna try to talk a little bit in different directions than what she's covered. So I really wanted to do sort of man on the street, but let's start a little bit with like the UCLA forecast. So let's go high for a minute, and then let's go man on the street level. So the UCLA forecast suggests the GDP will decline by 7.5% in Q2. And then we'll see another decline in Q3 by 2.35%, leading to, they think, an potential annual rate of a negative 5% growth in GDP. Now that would be significant in that it would show up as those are recession numbers, right? Now, whether that actually occurs or doesn't occur, I don't know. This is just, UCLA's most current update and their projected forecast. I think what's important about that is kind of this bifurcation between the man on the street and not so much. So the International Monetary Fund cuts its forecast for global economic growth itself, but it only cut it by 0.1%. And it's still calling for an expansion at the 2020 to 21. So, and they're also suggesting maybe an unemployment peak of up to 13% in Q4, which kind of aligns with the previous numbers we've heard of 18 million, right? Bruce, you talked about loss of 18 million jobs. Weeks.
Right.
So we might see a peak, but that would be a national number. This is not LA. This is not, San Francisco. This is not specific. This is a US number, would be potentially an unemployment peak at 13%. But seeing a recovery, even UCLA with these drastic numbers is suggesting that there's going to be an avid and aggressive recovery in 2021, or at least an avid and noticeable recovery in 2021. So kind of just like laying some economic background, I was like, well, how is this going to wash through? And I really think that I'm going to talk to the bifurcation a little later. So in the Pasadena markets, because you asked me to talk about Pasadena, La Cañada, Flint Ridge, Altadena, what we were heading into this in sort of a sort of balanced market. We were already slowing down. The market was already losing steam from where it was back in the end of 2019, or not 2019, but end of 2018. It's been sort of this slowing progress that I have noticed. Being a flipper in that market myself, as well as being an investor and a hard money lender. So I was seeing basically that the market now was about balance. So days on market was 49 to 50 days on market, but the range is all the way down to the shorter end range is 29 to 30 days for a hot product, right? So things were still moving, there was active, but since I couldn't find the most recent numbers, I ended up talking to some real estate agents that specialize in that area. And they really talked about how upper end homes are not seeing buyers, that those seems to be, the kind of frozen in the Pasadena area. Now, I don't think it's going to stay that way, because what I was also hearing from the same people is they're really doubling down, again, bifurcation. If you're a broker and you have funds in the bank, then you're able to do a virtual tour, encourage people to do a drive-by, have your buyer send in proof of funds, and then schedule a one-on-one showing. And that seems to be what's going on in the offices when you're dealing with the upper end properties. I actually don't know below that price point. I wasn't able to talk to somebody, but then again, you know, a lot of Pasadena properties are 800,000, 900,000 or above. So we're dealing with a particular segment of people. They're also pushing things out to their network, to their pocket, doing pocket listings and pushing things out, but being very careful in things. But even the upper end brokers, at least the ones I were talking to, were saying, yeah, we're putting our own money in to make things continue to run, but we're not too sure how much longer we can continue to do that when we're seeing such a drop in volume, such a drop in listings, right? So, and a drop in showings. So that's what's going on, at least word on the street in the Pasadena market. But, you know, as, you know, there was definitely a scare, you know, when Mayor Eric Garcetti, you know, described and said that real estate transactions are considered essential, but open houses are prohibited. There really is something that's having to be walked around. So I'm kind of like, let's think this through for a minute, because that's kind of where I'm just trying to lay some backgrounds about it. Let's think this through. Let's start with two assumptions. One assumption is that my assumption is that the virus is going to be here for several more months, if not longer, right? We're starting to hit what they hope is a stabilized number. And in a week or two, they think that we might hit our maximum number of seeing coronavirus, you know, continue to expand, and maybe then starting to see a contraction in the LA area. But that's also, if you think for a minute, that's also with people on the stay-at-home order. So what happens when people stop being on the stay-at-home order? How do we actually stop the rolling of the coronavirus again through a new segment of the population, all of those that have been capable of closing ourselves at home? So I don't think that this is going to be a quick, you know, gee, everybody stay at home. We're going to, you know, we've got the virus under control. Everybody can come back out again. You know, I think that if you think it through, we're going to have to accept that this, if we're going to continue to mitigate this virus, what we're looking for is either a version of cure, a way to slow it down, or we're looking for a vaccination, right? And that's what's going to take time. It's not the virus, and it's the capacity to actually not catch the virus or mitigate the effects of the virus. It's going to take the time. And that's why I think we're not going to see one wave, but we're going to see more than one wave or an ongoing effect in the way that people are managing the virus and managing their lives around the virus. So I'm sorry, I'm trying to work out my lights here. So that's one assumption. So it's the length of time. I think we need to think about that. The second assumption I want to lay out here is that what I'm seeing on the street is that the lower end workers in the service areas are really the ones that are losing their pay. Waiters are not waiting. Salespeople are not, and retail stores. Housekeepers are not cleaning house. Caregivers are not having children come to them, right? I know somebody who works at First Five, and she was very clear that right now their primary concerns is getting food to families that with young infants who don't have food, more or less paying their rents, right? So there's definitely this sort of like, you know, gee, the worker class is the one that is taking, the man on the street is the one that is taking the hardest hit of this. You know, and like we said, you know, a 300% increase in unemployment in a very short period of time. So Ray Dalio said, and if he put out a really good update on this, that if you want to, you know, listen to it. Ray Dalio said it's really all about, you know, what he calls P&Ls and balance sheets. But it's those with assets on their balance sheets are generally going to do. That's really kind of what it boils down to. So to give examples. So I've talked to a couple different people who hold assets, right, as a consultant, and I'm capable of reaching out to and say, gee, you're holding assets in this class versus that class. What was the news I was hearing on the street from them as property owners? So I talked to one person who owns houses here in Pasadena, and they said, hey, you know what? Not a problem. I had two houses, and I had a house and a guest house that were up for rent. I rented them both. This wasn't a big problem. You know, we met there at a mask and gloves. It's done, and I'm collecting my rents at my other homes. But yet I've talked to other people who own maybe a C or D grade triplex, and they're getting no renters, right? Nobody's moving into those units. And there's another one where they own a triplex and they got one rent out of 3 units. And so that's where we're seeing our 30% non-payment of rent is really based on the grade of asset. So if you think about how it rolls out, so renters in D and C were probably going to have a harder time. They're the ones that are going to either be staying in their home, staying in their apartments, or staying in their units because they have protection, but they're going to have a harder time when it starts to unfold. They're going to have a harder time getting the job. You know, when we start actually starting to hire people, how long is that going to take while this continues to roll out? That's my question. So I think that might take a while. I think it might take longer for them because they don't have the cash in the bank and they don't have the capacity to support themselves. I think as this rolls out for them and it goes longer and longer, it's going to be harder on their capacity to buy a car, harder on their capacity to pay their rent moving forward, to catch up on the rent that they're behind. So I think that's going to create a bifurcation where they're going to have a harder and harder time in the months, even after the virus is done, even after we're capable of creating a version of a cure. Whereas the renters in the A and B units are probably going to do better. They're more likely to work from home. They're more likely to have a higher degree. They're more likely to have a computer. And they're more likely to have the internet that allows them to continue to work from home and have the capacity to pay that bill. You know, what does $600 mean to somebody who's in an A or B unit? Even in LA, that is, you know, their car payment, right? Or 2 months worth of car payments, but it's not their rent payment. So it's not their rental payment. So this is where, when you talk about, you know, opportunities as investors, I think we're going to see the opportunities not so much in the A and B units, but in the C and D units. Opportunities to purchase, but also, you know, how can we help, right? So I have to do both sides, right? If we're an investor, this might be an opportunity to purchase in because they're going to be landlords who can't hold units that are empty for that long, but also, you know, an encouragement to help out, you know, send that grocery bill, that grocery card that you send at Christmas. Absolutely. You know, if you've got renters that need to unroll their rent, you know, work with them. But again, it's your holding power as well. Let's be clear. We are investors. We are not banks. We're not endless pits, you know? So just trying to speak to both sides of the issue at the same time. Can we be humanitarian while we're moving through this? Especially if we have the opportunity. So single families. So I think personally in the Pasadena, Glendale, Altadena market, the pent-up demand is gonna show itself pretty quickly. Right? People are going to be pulling and contracting off the market, but that 33% drop in listings that we heard about, and you know, David talked about in NorCal, is here too. That drop in listings is going to pretty much unravel itself pretty quickly. Right? As soon as we work out the coronavirus, as soon as there's a solution, as soon as the economy is willing to move forward again, you know, I have a home on the market, and what I found interesting was that the buyer that bought the flip home I have on the market was as eager to sign the buying agreement with me as I was to get it signed before this continued to get even more complicated. They wanted to secure a home while there was a home to secure just as much as I wanted to secure a buyer when I knew there was a buyer out there that was willing to look at my house. So I'm seeing it on both sides in my own experience. So I think that's going to unravel pretty quickly. It's the single family residences that are the lower end. I think we're going to have a harder time finding a buyer. Not that the buyers don't want to buy, but again, how are they going to be able to prove their W-2s and their proof of income? It's going to take longer for them to unravel. That's where I think the harder hit happen. So, and how long can the government continue to support? You know, yes, you know, we've got $600 for the U.S. worker. We've got the EIDL loans at, you know, $10,000, you know, quick access and forgiving on larger loans. The PPP, the payroll repayment program, will help. All that will help the small business owners, and that is helpful. But how long can we continue to roll out? Even China, where the coronavirus has started, it looks to me, and I wish I had the statistics in front of me, but looks to me like even China is starting to go, our economy can't keep holding. We can't just be on pause for forever. You know, we need to reopen some of our cities to be able to do that. And some cities are reopening more I guess you could say aggressively or more willing to open than, you know, the city right next door. There's still blockades between cities so that you can't travel from one city to another in China as a way of, you know, locking people into a set geographic area so that the coronavirus doesn't expand. But even they are starting to go, hey, our economy can't take this. We have to almost declare it done, just because how long can we economically hold? So I think we want to look at it as a bifurcation, a length of time, and a bifurcation between A, B and C, D product. And how can we be a humanitarian moving through this and moving forward?
I'm going to ask you the question here. What are you hearing about the jumbo market in LA? Those higher
As far as loans?
Yeah, financing for the higher end flips.
Okay, I'm hearing that is still available but harder to get. What was interesting to me is I'm hearing that in the lower end, when you're trying to get investment loans, that those terms are starting to go wonky. I heard literally only one length of time for investment properties. But again, this was out of state. This was not in state. So I can't really talk to LA on this particular one because my smaller investment properties, my investment properties, to be accurate, is actually out of state. So I've heard that those loans are actually wonky. So I know the theory is that loans should be available, but I'm not so sure that the secondary, the investment market, the loans for investors, secondary homes are going to stay stable.
Kathleen, I'm going to give you a heads up because I don't think Iris is going to be back. She has twins and she's having twin issues. So she texted me and said,
no, yeah, go ahead.
Did you make it, Iris? Okay.
No, this is Christina. I talked to her as well, and I heard the same thing, that she's having twin issues.
Okay, so I just wanted to give Miss Kathleen Kramer a heads up that it's coming. One of the interesting things I have heard from brokers is that you don't have looky-loos in the game right now. So when somebody's willing to make the effort to go see your property, it's not a nosy neighbor. It's somebody who's actually going to probably move forward with the deal. It'll be interesting. Have you heard anything about the urban exit? Are people sort of maybe rethinking some of the more urbanized areas of LA and they just want out?
I would love to say yes, but I haven't.
Okay. Yeah, the Ray, somebody was bringing up the issue with undocumented people without papers. This is a real challenge for a very specific population of people. Some people might not have people that work in the education sector, but some schools in inner cities have 90 to 100% of their kids that are reliant on the breakfast and lunch program to eat. So I would agree with what Christina was saying. I think there is a bifurcation of the product that we need to talk about, and it is going to be the C, D, and F neighborhoods, quite frankly, that is going to really, really struggle.
That's why Section 8 would be really important.
Correct. So you're starting to see the articles of a mile long for food and stuff like that. I mean, it's scary. There is definitely the have and have-nots, and it is unfortunate. So, well, Christina, thank you. You're going to hang out as well for questions, possibly?
Yes.
Okay.
Okay.
All right, Miss Kathleen, I am going to, I know you've got charts. So.
Yay.
I have some charts. Can you see them?
Yeah, I'm getting a lot of feedback on your side.
Okay, hang on. Oh, not right now. I'm going to try to plug in my mic here. Hang on one quick second.
Yeah, that'll help.
Sorry. See if that helps. Did that help?
No, but you might have to select the mic in the drop down of where the sound is coming in under the settings.
Okay.
I know you sort of got caught off guard too, so thank you everybody for your patience. You know, another thing I was thinking about is that flips are typically vacant, which might be a bonus compared to if you're walking through somebody else's house that's got all their furniture and personal belongings. That might actually be good to have a vacant flip.
Yeah, you can see it clearly.
Yeah.
You know what? I muted myself and it didn't help the feedback. So I'm wondering if Christina might still be on.
Aaron, it looks like it's Paul.
Oh, it's Paul. Okay, Paul, I'm going to mute you, buddy. Yep. Thank you. All right.
Okay, beautiful. Is that better?
It is perfect.
Okay, good. So good. So now I'm gonna, can you guys see my screen?
Yep.
Okay, fabulous. So thank you so much for having me. For those of you who attend REIA, you know I do the market update. Can't have me. I'll keep doing it. And I am known for going long, but I'll try to be disciplined today and keep this short. I have, let's see if I can. Sorry, a little bit of housekeeping on my end so I can get this into full screen mode. There we go. Okay, we'll skip my background, but I've been in the business a long time. I do have a bachelor's in economics, and I do speak at REIA. And right now, my husband and I, we mostly invest in non-performing second trust deed notes. So I have a little bit of anecdotal information for you on that because that's going to be a hot area, I think, of investment on the other side of this thing. So might be an interesting thing for your listeners to hear about just some deals that are coming down the pipeline right now and what we're seeing in the marketplace on that. So we're definitely late cycle. This is a little slide that I used a couple months ago when we were talking about how to get liquid and get ready for something like this, not knowing that it was on our doorstep. So at any rate, here we go. Here's a little bit about Orange County and what's going on here. So for many, many months, maybe the last 2 or 3 years, we've seen a lot of inventory in the high end, less inventory in the low end. Most of our demand is in the low end, and less of our demand is in the high end. So if you take a look at this, this is as of last week on the 7th of April. The expected market time last year in the under 1 million price point was 73 days. It went down actually to 61 days. I think this is mostly transactions that were in process when the lockdown occurred about a month ago now. Anything over 1 million is getting much tougher to sell now. So you'll notice that our expected market time over $1 million is 109 days. It's 10% of our inventory and 8% of our demand. And then as you go up from there, you can see that by the time you get to that high-end price point, you really have a very extended marketing time. Part of that is that jumbo loans are getting harder to get. Chase came out this week and said that they're going to lock down the credit quality, just like we saw in 2008 and 2009, where these loans really went away almost entirely. Right now, Chase is at a 700 minimum FICO score with 20% down on a jumbo loan. So as long as Fannie Mae, Freddie Mac, and FHA are still lending, that lower end of the price point, I think, is still going to be able to transact. But the Alt-A, the loan, the bank statement kind of loan, those kinds of loans are gone for the most part. So this is really fantastic for people like Bruce and others who are in the private lending space, because all of a sudden you've seen those types of transactions materialize. So there's a much bigger market now. If you're sitting on a pile of cash and you want to get a first trust deed on a single family home in Newport Beach or, you know, Huntington Beach, Orange County area, there's much better market for a private investor to go in there and get a rate that has a reasonable rate of interest in the 7s, 8s. I saw one of the aggregate lenders that does a lot of marketing. They have a pool of money. They were actually marketing an 80% jumbo loan with a good credit score. It was like a 660, 680 credit score at 7.99 on a first trust deed. So very interesting stuff. If you're willing to jump into that owner occupied space, which has a lot of regulatory requirements, that might be a little bit of opportunity. So active listings, a lot of people, just like in LA County, just like in Sacramento, we're seeing that the active inventory has declined. So last year in April, we had 6,800 active homes listed in the MLS. This year we're at 4183. So active inventory just in the last 2 weeks only went up 0.6%. We did still manage to add some listings in the last 2 weeks, but we're missing about half of our inventory. So 45% of our inventory is just not on the market right now. On the other side of that is demand, and this is really the most dramatic chart. If you're interested in this kind of data, I would highly recommend, I put it on the top here, you should go to the Orange County Housing Report. This is Stephen Thomas, he's a local title rep. He's been putting out these reports for years, and recently he expanded into the Inland Empire, LA County, San Diego County, Ventura County. So you can go to reportsonhousing.com and you could subscribe, and it's by the area, but he does such a fantastic job, and it's really, if you're in the business, it's really worth looking at the numbers, and he has very accurate numbers, and the reports come out every 2 weeks. So just a little plug for him, because I've been leaning on his numbers for years, and I always want to give credit where it's due. So over the last 5 years, pending transactions have trended up in the first 2 weeks of April. So this is really the time that we've seen a lot of inventory come on the market. This year we're down 814 over the last 2 weeks. So the home buyers are pretty much staying home. 52% decrease over this time last year as far as where we are with pending sales, which of course those are the ones that are in escrow. Some of that is because of the lending criteria. So anecdotally, I spoke with several realtors this last week, and the jumbo stuff is just the borrowers are having a really hard time getting their loans through. The appraisers are having a very difficult time getting in. And of course, Fannie and Freddie have come out with these specialized appraisals where you either get a waiver and they don't have to do an internal inspection or appraisal inspection, but the jumbo loans don't have that luxury. So I haven't heard of any jumbo lender that's willing to do just an external drive-by appraisal or do one of these fancy appraisals where they have the borrower go around with their phone and it's geocoded and they're taking photos of different parts of the house at the appraiser's instruction. So I haven't really heard of any kind of workarounds in that space yet. And of course, the secondary market in the jumbo space is very touch and go right now. The Fed may or may not be supporting that end of the market. And so I think that most of the banks and lending institutions are really just kind of clamping down and going very, very conservative. That might take a while to come back. It did take about a year before we started to see that loosen up after the last crisis. So that might take a little while in that jumbo end. So hopefully most of our investors are not holding jumbo product that they're trying to move right away. This is more of a function of if your family wants to move or if you happen to live in Orange County. So just a little overview, and I would imagine that Aaron, you're going to be handing these slides out to folks. I can certainly forward them on. But really, just as a summary, homes priced below 750 is still a hot seller's market. If you can get an appraisal, people are doing the virtual tours, and they're still going in, but of course, transaction volume is decreased significantly. So, but even in February, we weren't really seeing any discounting. We were at sales to list price was at 99.9%, which, so it's pretty much if you went into escrow, you were good. Now, switching gears a little bit, I want to talk just for a couple of minutes about the rental market. So I did an informal survey. So what this entailed is I called 3 property managers that I personally have a relationship with. One of them primarily does single family homes, not at the bottom end of the market. This is Orange County. So 75% of this is single family homes in Orange County. How many of those tenants asked for a delayed rent payment in those single families? 3 to 5%. So about 4%, she said, actually approached her for a delayed rent payment, and she had followed kind of the AOA guidelines or the forms that the AOA had put out, and then also some internal things that they had worked out for their company. And they had a process for them to apply for a deferred rent. So that's kind of how that went. So that's good news, but then you have apartment management, and the apartment owners that I know and managers I know primarily work in the Long Beach market. So this would be maybe more of your entry-level tenant, the lower end of the spectrum on the apartment side, and 15% of their population asked for a deferral. So I have a feeling that more than that would have problems making rent. And that was kind of the feeling, was that they were thinking that maybe they would have people that just didn't pay. But 15% of their tenants actually picked up the phone and called them and said, hey, I'm going to have trouble this month. Probably a few more are going to just ignore it and hope that it goes away, like sometimes people do. So apartments and single family homes, if they're vacant, are harder to show for the same reasons that single family home, or the residential real estate is hard to show. So you're seeing less movement. Aaron already talked about the California Judicial Council, and then the Apartment Association is a great resource. So if you're a landlord, I think what you want to do is a good resource, if you don't already have some tenant agreements, is go to the AOA website, and that webinar that Brand was on, that they did, that's posted there for free. And they also posted a bunch of their forms for free. So the AOA is a really great resource for that. Amanda and already talked a little bit, and Matt already talked about the loan program, so I'm not going to go into that. But starting last week, apartment owners might want to try actually the EIDL SBA program for that. So here's a couple of resources for you: that Apartment Owners Association link, and then also for people that are interested in private lending. So let's say that you were ahead of the game and you put aside some cash and you want to get into private lending. There's a great law firm. There's an organization for private lenders called the American Association of Private Lenders. AAPL is the organization name. And it was pretty much founded by this law firm in Orange County called Gerasi. And they have been having a series of webinars that are free. They're posted on their website, and they're just fantastic. So if you're curious, a lot of people ask me when they hear that I'm doing notes, they ask me, how do I get into this side of the business? How do I learn more? Well, here's a way to learn more, and it's free education, and it's really on demand. So you can go to their website, gerasillp.com, and you can tap into some of those things. One of the other questions that I was getting this week was, gosh, Kathleen, I bank at Wells, and personally I bank at Wells, and Wells, I'm not really that excited about Wells right now. Sorry, Wells. But they basically are saying, hey, sign up on this waiting list and we'll tell you when we're ready to talk to you about your PPP loan. So I went to the SBA department, and in Orange County, there's a list here of banks that are still doing SBA. They're SBA approved, and they're approved for the express loans, which is the express pathway. And they're still taking applications, I guess, as of a couple of days ago when I looked this up. So there's some resources for you to check out. If you're interested, OCREIA, we were dark this month. We were supposed to have our meeting last week, but we are going to do a free Zoom meeting next Thursday at 5 o'clock. And you could go to ocreia.com, and I'm going to give a much longer economic update and talk a little bit more about the credit markets and what's going on with credit markets, and give you a bunch of resources on what you can do, and as far if you want to educate yourself on what's going on and what to watch for. But really, as a summary, I think that the biggest issue that I see, and Bruce, I'm really interested to hear your opinion on this, is I think that until we have price discovery in the marketplace, it's going to be very difficult to make that next investment in real estate. And what I mean by is we don't really have an active functioning market right now. We don't know when we're going to be able to collect rent if you're buying a rental. We don't know if you're going to be able to get in to get an appraisal done. We don't know. There's so many things that we don't know. If you're doing a jumbo transaction, or you may not have financing available for a buyer on the other side. So a lot of the construction projects that were going on, like in LA, where they were tearing down a house and putting up a fourplex, or those types of transactions, those transactions really are going to, that whole segment of the market is going to kind of freeze. until we can get some price discovery and the markets kind of open back up again and the lenders come back into the marketplace. So for me personally, I think it's a little bit of a price discovery issue. And so I'm interested to hear what Bruce might have to say about that. And then finally, I have one little anecdote that I'll just talk about, a transaction that we did recently. We were making an offer on a pool of loans and trying to figure out, okay, how much do we pay for these loans? Because obviously it's a different world and it's a different kind of price point than what we might have been looking at if we were making a bid on these loans in January. And so we made a couple of bids. We made 2 bids on pools and they were turned down because we went in too low. And then finally, we kind of found the market where we went in about 10% lower than where we were before on the loans that we were buying, and we were able to secure some of that pool. So it's not a big buy. We're kind of buying on the way down, in my opinion, but we had an investor that wanted to go with us and is patient and willing to wait the time that's going to wait for us to get into the court system and work some of these loans out. So just a little bit of anecdotal information for people to kind of get an idea. You know, I just don't think that there's a lot of transactions to do until we actually can discover what the real market prices are.
Kathleen, I'll share with you one of the things that we got the opportunity to look at was a $250 million pool of hard money loans. The problem was that the Wall Street lender that had it had been funding those on a credit facility that had a margin call when the stock market went down. So,
right.
There's a few problems here. So they were taking a 30% haircut on the principal, but they were originating first trust deeds that were funded at 90% of purchase with 100% of the repairs at 7%. I just don't think that's the rate. So I don't actually think that's the price.
Right. Right. It's true. I would agree. And you know, we have a very strict buying criteria. So we're buying non-performing seconds, which, you know, a lot of people go, oh my gosh, that is so risky. But we have a box that we fund that we buy within, and we tightened our criteria down 10% on the CLTV, and we take the UPB, the unpaid principal balance. We look at the CLTV, we make sure the first is performing, which that's a huge question mark that I probably don't have time to get into right now, how that works in a forbearance market. But basically, so we have this box. So we just went in, the first 2 bids we made last week, we went in 20% below where we would have bid in January on the UPB. Okay, so the interest is just whipped cream on the top of the cake, right? When you buy a distressed note, the back, the arrearages and all that is just whipped cream. What you're really buying is you're buying the unpaid principal balance. So, you know, so we went in 20% and we didn't win any of those bids. So we went in at 10 and we were able to win a part of our bid, not even all of it. So there are still buyers in the marketplace. And so they're not as many, but it's an interesting time right now. And we're excited because we think there's huge opportunity in this on the other side. And our thing is how can we help these people keep their house? That's our goal. When we go into it, our goal is how can we help this person? We don't want the house back. You know, we're not in it to own it. We want to help the person stay in their property and work something out. So.
Are you talking about California trustees predominantly?
No. Actually, we think Californias are way overpriced, especially with the political climate. Here, we think that, you know, forever people have always been saying, oh, we only want to buy California. We want to buy California notes. We want to buy California. And it's really not our cup of tea.
Do you see migration issues for California over the next 5 years?
Absolutely.
Okay.
Oh man, hopefully everybody's drinking while you're on the call. Anytime
Get a glass of wine.
Depressing, everybody take a shot.
I gotta tell you, it's so fun. It's so fun to just listen to all of these smart inputs.
Oh yeah.
And people. I mean, it's such a good balance of like a Pasadena and then an LA and then a Long Beach and then you know, you have the haves and the have-nots, and even Orange County. I was raised in Stanton. I don't think that really qualifies as a city that most people in Orange County want to claim, but that was where I was. That was where I was in Orange County, and it doesn't look anything like Newport Beach.
Well, thank you, Kathleen. And you're going to hang out for questions as well?
I will.
Okay.
Okay.
All right, Derek Harms, since we're going to get to you a little bit earlier than expected, I'm handing you the slides. So,
all right.
we've
So,
got Derek.
He's record it. You got that okay, all right?
Sorry, what'd you say?
You got the permission to record it, all right?
Yes.
Got it.
Okay. And then we've got Lenksa Bracknell. So Derek Harms, he's with Compass Realty. So what's really great about everybody that we asked to come on, we're going to be asking some very different questions of these two. But Derek is currently the president of the NSDREI, so the North San Diego Real Estate Investors Association. And then Lenska is on the board with SDCIA, and she and I have been working together closely on ADUs for the last year. She's got some background in vacation, so I'm really excited. So both these are in San Diego, but Derek, you're going to start us off?
Yeah, absolutely. And thank you, Lenska, for a tag team in San Diego County with me. So yeah, Lenska and I talked earlier last week and decided that San Diego County wasn't quite large enough to break up into North and South counties, so we figured we'd just go at it together. And with that said, first off, thank you guys at the Norris Group, Aaron and Bruce, like for what you guys have been doing for years and things like this. It really helps the investor community have a place to go in times like this. And Bruce, I know like me and my cohorts and a lot of the people I trust really look forward to hearing what you have to say. I look forward to the podcast on Fridays to see, hey, what are they going to be talking about this week? What's happening with the COVID-19 update? So thank you guys for that. The North San Diego Real Estate Investors Association, you know, we meet up in Oceanside, so pretty far North County. We have a really great group, solid board of directors, and just a really wonderful group of real estate investors and practitioners that come there. And so thank you to all those who are listening tonight. I'm going to share my screen and go through a couple slides that I put together because I did a little research and I want to make a quick statement and let everybody know that, you know, you can do your best to talk to as many real estate investors and agents and practitioners across the county, but you can only talk to so many. So this is simply a sample size of who we were able to connect with. But I think it does a pretty good job in describing the sentiment and the feelings that everybody has in these particular spaces.
Did you hear me? Oh, yeah.
It looks like we got a little feedback.
I'm not sure who that is. I'll try to find out.
All right. Let's see here. Good meeting. Give me 1 second, Aaron. I'm just sharing that.
Either that or Lenska is a ventriloquist and she's messing with us. That's sort of like you, so I got to watch out.
You know, you got my good personality today.
Oh, I'll leave it alone then.
Yes. But while Eric is pulling up those slides, I just wanted to say greetings. And like Spock always said, live long and prosper. And it's certainly weird times where the black market for haircuts and us wearing masks indoors to keep us from snacking all day long, and that my car is getting 3 weeks to the gallon is unprecedented times. And Bruce, I don't think you have a chart for it. Those are all uncharted territories we are in.
That's right. I've even thought about that term, uncharted. I don't have a chart for this. You're right.
And Eric, are you ready?
Yeah, are you guys able to see my screen?
I am not. I tried to reset it for you. It's not. Did you accept the notification to allow it?
I did.
Now here at the coast, we're going at surfer speed, not at Trump speed. So if
there we go.
You got it.
All right.
Okay. All right. So you guys can see my screen, right? See all the slides?
Yep,
Yeah,
we're good to go.
Perfect. Okay. So I already introduced our investor group. Really happy to be here. Here is some of the data. And this was put together, and I want to give a special shout out to Jerry Ryan, who does our normal monthly market update, and SDAR, and Brian Daly, and a few other people have helped me aggregate this data. And it's really interesting when you go down the data rabbit hole, how much time it can actually take, and how interesting some of it can get. And you at some point just have to stop and just put the data that's relevant and move on. So Bruce, I can only imagine what you go through when you're putting together your annual reports.
I just to Aaron after I'm done.
Yeah, I would delegate myself. So here's a snapshot, San Diego market update. So very interesting. In all of March, you had about 783 new listings, and just in essentially the first week of April, you had a 26% decrease. That same time frame, you had legitimately a 50% decrease in pending sales. So the amount of homes that got accepted offers were cut in half in the beginning of April. And I'm going to touch on the sentiment that I've gathered from agents in the county here in a second, but it's across the board. And sales, you can see, have gone down, and inventory has actually increased up a little bit. And for those of you that don't know San Diego market, to put it in a nutshell, our median detached sales price is $680,000, and we have an extreme luxury market, and we have a lower price market as well, as most areas do. But and I'm going to touch on these numbers here in a second. And Lenska, feel free if you want to chime in on any of this.
Derek, your time is up. It's my time. Not yet?
Go ahead.
No, you just go ahead. But I can only ditto what you're saying. So
you're seeing the same things, right? Like pending sales are cut in half, listings are down. I mean, it's just across the board, right?
Mm-hmm. I do have a different interpretation of it.
Interesting. Well, that's really cool. I can't wait to hear that, because the way we think data is
I know.
quite different.
You noticed that.
All right. Real estate agent sentiment. So some escrows have canceled, not a massive proportion here in San Diego, from what I can gather. They've had buyers that got scared and some buyers that have backed out, but for the most part, we're still seeing deals get done. A lot of wait and see approach, whether it's agents advising their clients to withdraw their listing that's already listed or wait to list it. Affordable price points, and I put that in quotes because it's all relative, but under the $800,000 mark, you're still seeing a lot of movement. And of all the agents I polled and talked to before in preparation for this evening, the overwhelming sentiment was that anything under 800, some of them were saying under $1 million, but anything under 800 was still having some movement. And how agents consult their clients right now is huge, because the buyer perception is a problem, and you're getting a lot of very low offers from buyers just because they think they can, but the seller motivation hasn't been met yet. So there isn't a bunch of sellers that are extremely motivated to sell for below what was the market price at this point. Across the board, most agents that are doing volume are telling me that the luxury space is stalling, and each agent would describe luxury at a different level, but at least for the sake of conversation, it was definitely over $1 million. And in San Diego, $1 million isn't really quite the luxury market, I would say. I think it would probably be maybe 1.5 and above. And I say that it's stalling, but you'll see here that Bill Gates just bought a $43 million house in Del Mar, and he closed on that, I believe, on March 27th. So Not that that's indicative of the luxury market, but I thought that'd be a fun fact to share. Thank you, Lindsay Dunlap. It's really hard to get everyone involved to sign the COVID-19 form. So according to CAR, the way we interpret it is you're supposed to get agents, buyers, sellers, vendors, whoever it is, appraisers, home inspectors, to sign the COVID-19 form before entering the property. And from what I've gathered and what I've seen, it's very difficult to do it. Some are, but for the most part, I haven't seen many. Vacant houses, they're still showing and selling. I talked to a lot of flippers, which I'll touch on in a second, that people are still getting their vacant homes shown and sold. And I think vacant homes have a little bit of a benefit right now because there's no seller and family potential to deal with, and any sort of virus concerns there. So that brings me right to the investor sentiment. So again, I talked to quite a few investors, and thank you to all of those who took the time to talk to me today and in the previous days. So what I did was I took notes of every conversation I had with people, and then I put here on this screen the common themes that I got from everyone. And so these were them. Audit your portfolio, trim the fat and get a little more liquid, and do almost essentially like a SWOT analysis and see where your strengths are and your weaknesses, and really tailor your portfolio to where all that lies. And if you can, stack a little more cash in case buying opportunities come down the pike here. And that seems to be what a lot of investors are preparing for a buying opportunity. Will that happen? I think the jury's still out, but if you have some liquidity, you can strike when they do show up. Some of the friends in multifamily space that didn't quite have locked in long-term low interest rates yet, I know a lot of them are scrambling to lock in some of those loans if they're still available. And when it comes to the flippers, we're seeing a lot of people across the board that are doing volume, still making offers, but adjusting for a longer hold time and lower resale values. And the lower to middle price points here in San Diego are still the most desirable. Over time, they've typically been the most desirable price point for house flippers, and they just typically present the highest margin of safety and the least discerning buyer, and that seems to still be the case right now. And for what it's worth, I personally have seen so much demand in that space. So we listed a house a couple months ago, a month and a half ago, and had 20 offers. I helped some buyers write offers on a house that had 21 offers. And so it's these price points that are still seeing so much demand, and there's still so much pent up demand that we think there's still be a lot of room to grow in this particular space. Some ways to get buyers in the door. So in San Diego, we use value range pricings if we choose. We don't have to, but putting that lower end of the range into a very desirable number to get people in the door. Maybe you won't accept that price, but you want them in the door. You can't get an offer if they don't show up. Seller financing, getting creative, solving problems, and putting together outside the box solutions that typically sellers weren't thinking about even 3 or 4 weeks ago, but now they're open to. It's interesting. I'm seeing a lot of emails come through from people who used to be home flippers and are now all of a sudden wholesalers, and they're not buying any of the inventory, or maybe they are, but they're just sending off the ones that they're not buying. But it's interesting over the past few weeks how many deals have get sent my way and multiple other investors' way just because of what's happening. This one was interesting. I polled multiple property managers, and the consensus was those that had over 1,000 doors under management, they were, less than 1,000 doors under management, collecting between 93 to 99% collection rate for April. And that's pretty indicative and relative to everyone that's been here on the panel. They're seeing a lot of the similar numbers. And so those that I talked to that had over 1,000 doors under management had an average collection rate of about 87%. And payment plans for those that couldn't pay, and they projected their overall collection after payment plans to be north of 95%. So still really high numbers, and definitely much better than I had anticipated for April. May, I think could be another story. So the sentiment again seems to be that May may be lining up to be a bigger problem, and the media is having a very big role in that problem. And a lot of tenants are contacting property managers saying, hey, we're told we don't have to pay rent, and we heard this on the news, and etc. And it's really backing property managers into a corner, and it's really unfortunate. So the group that manages my rentals and a lot of people I know in San Diego, SD Rent Pros, so they did something that was really cool, and I think a lot of other people are doing this as well now, but they suggested sending $25 grocery gift cards to each tenant that paid rent on time, and I thought that was a brilliant idea and agreed wholeheartedly to do that. And I haven't heard how that was responded to yet, but I imagine pretty good. I really like that idea. Leads for property managers that used to be coming in as a fire hose in this time of the year, you know, early spring going into that late spring and early summer kind of lease up period has now slowed to a trickle. So not too many people are inquiring about new rentals in San Diego, which is a shame. And this one really floored me. Tenant unions are knocking on doors, organizing rent strikes. And when I asked for more information, it was specific, and this is really happening. And I had no idea that happened. And so this opened my eyes, and that goes back to just gathering data for a gathering like this it really opens your eyes to a lot, even in your own market that you thought you knew. So lastly, Aaron asked me to talk a little bit about what we're doing at Compass. So Compass is a real estate brokerage that's grown tremendously over the past couple of years, and what they've done recently is offered the Compass Academy to all agents, regardless of your affiliation. So if you want to learn how Compass does it on the retail side of real estate, then it's open to literally anyone with a license, which I thought was really cool. And this program specifically is what Aaron wanted me to talk about, was the concierge program. So the Compass Concierge Program was rolled out last year, and basically what it did is it gave homeowners that had homes that need to be updated or renovated prior to market in order to capture the highest value on the open market. Compass offered a program to actually subsidize and pay for a lot of these repairs upfront without any deed of trust, but with a signed contract and a signed listing agreement for myself or any other Compass agent. You used to be able to get up to 5% of the resale list price after renovation. So if you had a $1 million house coming on the market after you updated it, then Compass would provide you a $50,000 loan at 0% interest, just assuming that you would sign a listing agreement. It's a great program. I've used it multiple times. I know a lot of agents throughout our company have used it a lot. Not only did it help you secure listings you wouldn't have otherwise got, but it helped secure higher sales prices, and it made the home sell quicker, and it created more equity for the homeowner. So it was a really good program. A bit risky though, you know, if you just look at all the details I mentioned, and the security was minimal. So you know, it goes without saying that they scaled this whole thing back by 80%. The mid of March after the quarantine was issued, or this might have been the end of March, but the whole program was brought back a little bit. And another cool program that Compass had that was essentially proprietary was their bridge loan program, which essentially allowed homeowners that had a lot of equity but no cash, which we know exists in this country quite heavily, to get the home they want using the home that they have already. So what would happen is a Compass approved lender would provide a bridge loan for a borrower and secure it against the home that they're in now using the equity. So you have to have equity, and help them pay for down payment and closing costs of the new property, while also getting a first trust deed, a long-term 30-year first trust deed as well. So it essentially allows you to tap into your equity, almost like a HELOC, but quicker, and in order, once you found the home that you wanted, to get to that point. So, but that whole program has shut down completely since this announcement was made in March. So again, think they're managing their risk. That's all I got in terms of slides. I mean, I could talk about this all night, but you know, I know we only have so much time, and I know Lenska has a lot to offer. So yeah, that's all I got.
Yeah, Lenska, let's go to you. You said you had a different opinion. What did you have
Yeah, if you can, in the meantime, get the screen sharing for me. I have a few things to add or a different opinion on the pending sales. So I think you guys can see my screen.
Yep, we're good.
Right, so that just I'm on the board of SDCIA, and if I may so, in the name and times where big means a lot. So we are the biggest investor club down in Southern California. I think we were founded approximately about 1976. I have been a member for over, I think now 12 years, and I serve as a treasurer, and you see that little plus behind it. That means I wear a couple of other hats, since we have a lot of members and do a lot of events. And by the way, thank you for doing this town hall meeting, and hopefully it will not be the last one. So I tried to behave today in order to get re-invited. So do I advance? All right, let me get to the next one. So I don't know if Spock would have known anything more than we know, because one of our questions we sent out in a survey. So I'm going to start local, very granular, and then I'm going to move up to the 20,000 feet level. He has a V-shaped greeting. So our question was if our members believe in a V-shaped recovery or other. We kept it at that because this was challenging enough, as some of our investors did not know what a V-shape or a recovery is. Okay. So the stats were about that only 36% believed in a V-shaped recovery, and the rest of them believed in anything other, and 2 just didn't know what it meant. So I'm doing the market update similar to the other associations. So I'm the one that comes up, and let me tell you, I put all my own graphs and stats together. I have nobody I can go online and get it from. So I spend hours on it too. So ditto on that. So I always say I want to provide you with stats, graphs, and facts. So no fortune telling, only fortune building. So here, just to go back on February key statistics. So I'm starting out at in February. All right. So February, we actually in San Diego, we had a super busy November, December, January, and February. This market was not typical what it used to be, where, you know, the median price dropped. As you can see, the remainder, this right here, is holding pretty steady, where usually you go down, you know, starting in June. So we had a super fast market. We had multiple offers. We had cash. We had very low active listings, and a year-over-year appreciation of 8.5%. So why I'm saying this is, so if we're going back to March, so here it came. So I was sitting at home, the whole COVID-19 came down, right? And I immediately started going into research mode. I called my title reps, I called escrow officers. Nobody could confirm what I was thinking, that escrows come to a halt, open houses are being canceled, a lot of canceled listings, nothing. For 2 weeks, every day I went on the MLS and looked for canceled, withdrawn, expired listings. Nothing struck me out of the ordinary. So what struck me out of the ordinary was quicker closings, 26 days, Pending sales dipped, but they only dipped because we didn't have the inventory. Sold listings, it's like the same year over year. Price per square foot increased to $430 in March. Yes, active listings were down 30%, which is unusual for that time of the year where we normally see more inventory. But the appreciation rate just slowed down, which tells you that is not normal. Normally in the summer months or spring sales season, we see that number increase and then later on in the year make the correction to the average of 5, 6, or 7%. So to make things even more interesting, this is the average percent of original price to closed price. You guys see that shooting up right here? So practically sellers were not lowering prices, and they did have a few multiple offers. So I figured we were like just flying an airplane in beginning of March, and the engine quit. So for all you pilots, when the engine quits, you're not going down, right? Your prop is spinning and spinning, and you're looking for a place to land. So all the buyers that have their financial house in order, and suddenly your house emotionally became your safe haven, your lifeboat, your office. Actually, it became my gym. Let me tell you, that's one of the hardest things I need to learn, how to do Zumba by myself in my master bedroom. Okay, so that's the hardest one. Okay, and so it was very active. So in terms of numbers, and Derek, you said, oh, the investors are all still cheering. Okay, so I looked up cash sales, how they compare to last year's and this year's month. So they were pretty consistent. I did it for the first 50 days in 2020 compared first 50 days in 2019. So we were about 330 for the 50 days. And the second 50 days going to March 31st, we had in 2019, we had about 500, and in 2020, we had 410. Still pretty strong, 90 less, but we had less inventory. So investors, the cash sales I consider are investor purchases. So then the last 10 days, we were down 50%. So I feel a little bit like we are like the sentiment is a little bit like 2007, 8. I remember I must have been one of the first people making a short sale back then, and I didn't want anybody to know, right? And then the tone started changing in half a year, where everybody was talking, how long, did you stay in your house? And, okay, I lost the house also in a short sale. So I think people don't want to really deal with reality, because even so, this market is not showing any signs of weakness, right? But I want to remind you guys what has happened from June 2007 in San Diego to January 2009. Okay, we went down less than 2 years, and then climbed back up to the same value at about 2017. San Diego recovered pretty quickly. Now we have a very strong employer, the military, the Navy. So that is our biggest employer, followed by the tourism industry, which is obviously hit hard by COVID. But then next in line is biotech. So we in San Diego is producing those test kits, okay? And by the way, they've been producing them since January, okay? So just so now to share what Fannie Mae does, this little homes purchasing sentiment index where they ask people, and that's pretty straight on. So this gives us an attitude towards real estate. So it dropped 11.7 points in March. And practically all indexes are down except for the mortgage rate outlook, which people think it will get lower, the +11. So we could say this is why some home buyers are still sitting on the sideline. Whoever does not need to buy or does not need to sell is not in this market right now. Even so, some buyers enjoying the less competition. Okay, so we then sent out a little survey, like I mentioned before, to our members, and so here are the numbers. So actually 40% said that they collected below 75% of their rent. Okay, also 25% said they will ask for forbearance, and two comments were, but my hard money lender is not allowing me or working with me. So I don't know who the hard money lender is, but that is probably more an important question for an investor. And they also said that 15% had trouble closing due to lending restrictions. So these are my numbers. So our members did feel the pinch, and I think so that's kind of what I had. That it started, and remember in 2008 it just started with one person not paying the mortgage. And yes, we have much better loans in San Diego or in now with mortgages, but remember, household debt is up, mortgage debt is up, student loan debt is up. So, and what I find interesting that we print all these trillions of dollars, somebody has to pay for it. And I think what is also unprecedented, that the Fed is now going to issue municipal bonds, where we always said, you know, I think Derek, this was always your question. What about pension funds? Suddenly corporate debt is rated BB, so we have a bubble with 3 Bs. So much corporate debt, and pension funds are not allowed to hold triple B bonds. So this is all going to be interesting. I just think we have not even started to comprehend what all these little things going to add up to. People, the banks are being, or lenders are being asked for forbearance. Yeah, the servicing companies still need to pay the banks, the investors, right? So if you're a non-bank and not backed by Freddie and Fannie, then you have to come up with it. Now, part of it is they didn't want to go through stress tests. So it will be very, very interesting times, and I feel like we're all coming together with a geopolitical issue, trade wars, currency wars. Thank God I'm the last person that's talking, because not that I'm negative. I know the Americans are very, and you can see it by how we handle the crisis, right? We make the best out of it. And thank God for all these funny movies, because laughing is still one of the best cures, I think. But also the crisis has shown us what other crises we have. We have people without savings. We have a medical system that's not adequate for all countries in the world. So Germany has 8 times more hospital beds per person, okay? And when you see Germany, how they handled it and how few deaths they had, so it's contributed to their good medical system. So I know I'm going off because all this I'm on information overload. I have been probably on 15 webinars.
Yep.
And the information is coming so fast, but it is so excited. And I need to thank Bruce for making me a much better, more critical person and not take for granted what you hear in the press. Find a chart, find numbers, and substantiate what the press is saying. So all I'm telling you, member Bernanke or whoever said to us 3 days before the hit the fan last time,
Yep.
the banks were so insolvent, so are our corporations now.
Yep.
My 86-year-old mom asked me, so how come that an airline does not have savings to weather a few days or a few weeks? So I think we will learn a lot about that crisis. And with that one, I think I'm going to close it, and I can't wait if Bruce has any inputs on the trillions of dollars we're printing.
What do you want me to do? Because I mean,
Let's
you want me to be brief and go through a series of things?
We have a very engaged audience, so the vast majority of the people that have started have stayed with us.
Okay.
And everybody, we are going to release this entire thing in its entirety on Friday.
Okay.
We're not going to divide it up.
Okay.
First off, I want to thank all the speakers for hanging out today.
Absolutely.
And doing all the homework that I asked them to do.
Very cool.
For those who don't know, a lot of these associations have supported us and I Survive Real Estate for the last 13 years, and these are some of our friends, and I think today you found out why. There are other clubs. Obviously we had 10 speakers today. We couldn't invite all of them, and we wanted to get a little bit of a taste of all over the state, but thank you guys for being willing to hang out today as well. Yeah, let's have you
I'll go
with
through
a few thoughts,
Okay.
and I'll start writing down the questions.
Okay.
That'd be great.
And I want to thank you, Aaron. I mean, your expertise in this field makes all this possible. Zoom is when you go fast. That's what I think. And now you've got a platform like Zoom, only you told me it wasn't Zoom to make this possible. So anyway, I'm going to quickly go through a lot of points, and it's got a lot of, I'm just going to go quickly and you guys can ask me questions. There's a few things. We have to see what our willingness to restart life is. So right now I'm walking around in a mask. If I deign to go to Stater Brothers, I mean, I've got gloves on and a mask, and there's very few people in the store. We all keep our distance. How quickly am I going to be willing to go to a 45,000 person stadium and watch an Angel baseball game and stand in line next to 40 other people that I don't know? I mean, will that take a while? That's a reasonable question. Will we change what safe means? I don't know if you've felt this, but I've spent all my life trying to put my family in a safe position with paid off assets and all that. But in the last 60 days, I've had to reevaluate what safe means. So I spent the money to buy a whole house generator that runs on propane and got a large amount of food, etc. You know what? I go to a place that I have a key to that I can go alone and work out in a dojo and lift weights or whatever I want to do. But I have to pass by a store that is never without a line, and it's the gun shop. That's a little concerning.
And everybody do a shot. Yay!
Yeah, great. Okay, so I think this is going to come down to, do we have coronavirus number one and done? Or do we have coronavirus repeat and repeat? I think outcomes are very, very different if we have repeat, and it's likely we do because we want to get out, but the fact that we're hiding ourselves is preventing the spread. So it would be easy to see that we might have several bouts of this, and that'll bring a very different demeanor to it. I certainly hope it's not going to happen, but it seems likely that it might. I think there's going to be people really rethinking how they live. As far as in New York, you're stacked on one another. Aaron, you lived in what, a 5-story place that there wasn't even an elevator.
Yeah, and I had friends that lived in a 7-floor walk-up, no elevator. Yeah.
Yeah, you have to pass people. You can't, and everything in New York is little stores, all on the sidewalks with 1 million people on it. So it's that kind of place is going to have some ramifications where people would say, you know what, I might not stay here. On the real estate side of this thing, interest rates are more expensive than they should be. The gap between the 10-year and the 30-year mortgage is way bigger than it should be. So you should be in the 2.7 range or less, and you're not. And it's because of all the problems with the funding. For us to have buyers, show up after this, I think they're going to have something called earning forgiveness. So can you go without a quarter or two of earnings and still qualify for a loan, or do you have to reinvent that in consecutive earnings for the next year or two? That would be a big mistake. As far as inventory for sale, I think, for the next 2 months, 3 months, nobody that has to sell will put it on the market. No one that does, they can pass on buying will be out there searching very hard. It's after that, I think we'll start to see emerge some things. The one thing we really have going for us is the inventory mix is all private party. There's no appetite for a lender to foreclose on anything. And they're not even allowed to.
They're not allowed to.
That's right. So they're not allowed to. So historically, when I look at price damage, and of course, this is a different dynamic. This is Grand Junction, Colorado, nationally, which is a benefit, by the way.
We're all going through the same thing.
That's right. Grand Junction, Colorado had an isolated thing. They didn't make federal policies to help out Grand Junction. So Grand Junction just went to 50% vacancy in rentals, had massive migration out and unemployment, and no fix nationally. But now we do, and that was one business that left for years and years. Here we're talking about a massive issue that might take months.
Well, my question to that would be the state of California has decided to really overstep its bounds in a lot of ways. I get it's an emergency, but you've got other states that aren't doing that. So it is happening nationally, but as a private landowner and a landlord, will I leave because it's clear that the state isn't taking my business seriously?
Yes. Yeah. There's going to be two big states of losers, two states that are big losers, New York and California.
Yep.
Yes. One because of health and California for policy. I think people with money are going to look at this and go, wow, I'm really the stepchild here.
Yeah.
And it doesn't seem like it's going to go my way anyway soon. So I might find a new home. And that'll be very interesting to see that transition, because I do think that'll occur. When you're a buyer and you're in that first tier where you've saved your $5,000 or $10,000 and you just used it up in the last, let's say, the next 3 months, that's a big deal. So your down payment just disappeared. You also may be attached to the businesses that go and close. So you work for a restaurant that was barely hanging on, and now 3 months later they're gone. And I mean, we already know some pretty cool businesses that are gone.
Mm-hmm.
That means tenants are gone for somebody that has the building, and it means that people don't have an income. So all of these things have domino effects on who can qualify. So I'm not sure what they're going to do about that, but they ought to think about something about getting people to own without a down payment with a safe loan program. We've talked about that before. It was mentioned about price discovery. So that's exactly kind of what goes on your mind as you participate when you're building houses like we are in Florida. What price point do we want to have those to be rented at? So that's you contemplate that all the time. Also properties that we're going to flip. So we're building a lot of houses. What's the price point and the amenities that we're going to be at to flip? Is that going to change? We're going to have price discovery for that. Or if you're buying notes and all that, all that's still on bigger picture. Okay. And this, I'm not going to cover this a lot, but I think there's going to be some big ramifications for world relationships with China. I think there's a price that's going to be paid, and I don't know how big it is, but I think, I think there's going to be a pretty healthy big price, lack of trust, and saying, you know what, we're not going to repeat some of these mistakes. One of which is, like most of our medication comes from that. That's ridiculous.
Yeah, that was brought up early on in the cycle that they might not send the medication. So
well, thank you for telling us that, because you won't make it anymore. I hope I hope that's the decision.
Do you think if that's the case that there will be some states that see manufacturing come back?
Yes, I do. I think they have to. Or we shift it to another country. But, that's possible that we don't want to pay the price that we'd have to pay. But what doesn't that help employment?
Well, you've got Japan who's spending several $billion to take automotive out of China. So yeah, they're already making that move.
Okay, so China's going to have some ramifications, and I don't know that I'm smart enough to figure out what the ramifications are for the rest of the world for that. But I think to me, that's a given. That's going to be a domino that heads downhill. Lenska brought up the Fed and the Federal Reserve and how they're having to solve stuff they never thought they'd have to be involved in, and also the federal debt explosion. It'll be very interesting to see how this plays out, where interest rates go, how we keep promises to retired people, and on, because it's going to get to the point where we know we will never pay this back.
That's why I'm wondering if this event will be used as an excuse to prop up pensions specifically, because they have the double whammy of the
stock loss, and the payment demand. Well, the cities, I think you may see federal law passed. Two things, I guess. You could have federal law passed to where you can break the promises on a federal level for states, which would be terrible because you have people that are counting on that opted out of Social Security.
Yeah.
Okay. I think the other thing, and probably more likely is a blended of it, is that the federal government or Federal Reserve will back that somehow to where the states can pay a certain percentage of those promises, and those people have a retirement that more mimics Social Security than it does the crazy number that isn't going to be met by any state, and they know it.
Yeah,
that's the problem. They know it. So, man, there's a lot to think about, and it depends. Does this last 3 months and we're back to the ball game? Well, that's a different outcome, man. If we go through and get this again in November, October, we start this whole thing again. There's some really smart people that we interviewed one of them, Raoul Paul. And the reason I did that, I respect his opinion, and he used the word depression in one of the other interviews he did. And that's why I had him on and specifically asked him the question, have you ever used that word? You've been around a long time. Have you ever used that word to describe an outcome of any other economic cycle? And he said no. And I expected he would say no. So, you've got Ray Dalio, that person's name was mentioned. That's a really smart guy who's taken a look at all the cycles. This cycle doesn't surprise him. It's like, yeah, we haven't done it in our lifetime, but it's been happening for centuries this way. The only problem is the ramifications of that. Sometimes he talks about that you have an upcoming power trying to take over an existing power, and you have the dollar being the world currency getting challenged, etc. So there's just a lot of big pieces of the puzzle that are at risk of change or pressure. And wow, I'm really not excited to have to go through this. Warren Buffett even said, well, I had to wait 89 years to see one of these. Well, when Warren Buffett says that gets my attention. I was, in 2008, I was watching Warren Buffett on TV and on a Squawk Box show. And he said this sentence. He said, if they don't pass the $700 billion bill, he said, everybody needs to go to their room and pray. And he was not kidding. I didn't go to my room and pray. I went to the bank to withdraw 100 grand. When I got there, there was a line of 200 people with IOUs because they were trying to withdraw some cash. I had never seen anything like that. Talk about one of those scary moments.
Wait, this is real life? You did this?
Oh yeah. 2008. I thought, okay, well, I need to get my share of cash so we can do that. Well, I knew the managers of some of these places, so I got the maximum allowable across counter. Didn't have to get in the line, but in a whole day, I got 20 grand. And remember a guy named Larry King, friend of ours?
Mm-hmm.
He called me. He says, I'm in one of these lines, trying to get 2 grand.
Wow.
Yeah. So anyway, when Warren Buffett says something like this is a first, yeah, the hair on my neck goes up. But you know what? Americans are resilient. So when we talked about the Boston Marathon event where runners got blown up at the end of the race. And, you know, it would be easy to think, okay, well, that's sort of the end of that kind of event. And then the next year, 33% more people ran in it, just to basically say, screw you, we're going to do what we always do and now more.
Mm-hmm.
I hope that's where we land. And I hope we say, you know what, even if it raises the price of medication, I think I'd rather have it made here, because then we know we have it. I think that's not a bad decision. And there may be other things like that occur that are long-term benefits. So I don't know. I mean, that's a lot to say in a very short period of time. And I really appreciate other people's opinions. And each of them have expertise in their own, you know, their own box of real estate too.
Yeah.
So you have different outcomes.
No, absolutely. Maybe we have some time. I mean, we're almost hitting the 3-hour mark, and I feel terrible. And speakers, if you want to chime off, just chime in. Maybe we can just do a few questions here and there. Matt and Amanda, you were up first, so going to bring you back on real quick. Airbnb rental relief. If the properties are out of state, which state would you request file for relief from? Where the Airbnb property is? You know what? I don't even know if they.
Sorry, was that the end of the question?
Yeah, sorry. My inflection was poor.
Yeah, he needs to say the end.
No.
Getting late.
I would say, I mean, definitely apply with your state of residency. You know, if you're a California, because, you know, if you're a California resident, you have out-of-state rental properties, you pay California taxes on those out-of-state properties as well. So I would definitely apply with your home state. I don't know if Matt thinks any differently.
Yeah, that's a good question. I mean, your home state, I would look at the state where the property is. I maybe apply both places. I mean, who almost knows, right?
Right, wherever you can get in line and they say yes.
Right.
If you are a retiree and do not file your annual taxes, how do you get the payment?
So for a retiree, if you are already on Social Security as your income, IRS has indicated they already have that information, so you don't need to file tax return. Now, one of the slides we showed earlier, that the IRS website now has what they call a non-filers page. So, you know, if you, for people who maybe, you know, are retired but don't have Social Security yet, that's where you would go. You know, put in some basic information, and also your banking information, and basically they'll do direct deposits. Essentially, I tested out the website myself. We don't, you know, obviously we don't have a lot of clients who are non-filers. So you put in some basic information and it creates kind of a simplified tax return to be submitted to the IRS just for the economics impact payment purposes only. So
this is going to solve a lot of my questions all up front with you guys. There is some questions on how, as a sole proprietor, can I file for multiple ones? What's the trigger where I know that I can apply as a sole proprietor, an individual with no employees?
An individual with no employees, yeah, if you're a sole proprietor and you pay self-employment taxes, you could still apply for the PPP loan as well as the EIDL loan. You would just be using your own Social Security because you don't have a tax ID number for the legal entity.
I've got a question, because I heard something I wanted to confirm. On the EIDL loan, that's the one that's got 10 grand of money that's not, you don't have to pay back. Is that correct? I think that applies to if you have a staff of 10 people. If you are one person, is it $1,000?
Yeah, that's a great question. So, you know, we were looking at that because there were some articles that came out, I think a week or so ago, from Inc. magazine and money.com, when they're referencing the SBA had a bulletin in one of their branch offices that said that. That bulletin has since been removed. So, you know, I mean, we didn't really see anything that indicated you had to, you know, this was capped by number of employees on the SBA's own website. However, I was just showing Matt, so after we did our part of the presentation tonight, we also applied for an EIDL loan, and we got a response back from the SBA from our application about a week ago. And the SBA in their response did say that the grant portion, that $10,000 forgivable amount, they are looking at it based on number of employees. So yeah, not as good of news as we had hoped for. So yeah, it looks like they're saying now there's this additional calculation, if you will. It doesn't mean that you're not approved for the EIDL loan. It's just saying for the advancement portion, which is the grant part, that it is based on number of employees, up to 10 for the 10,000.
Okay.
So it could be a total coincidence that we got it during the presentation, or maybe their SBA is actually listening to this presentation. Who knows?
What's the thresholds where I can apply for multiple businesses? If, say, I'm part of multiple member LLCs, is there a limit to how many I can apply for?
Our understanding that it's based on who files tax returns. So the kind of way we look at it is, if there's a partnership out there, the partnership files its own tax return. So depending on what kind of business they have, what they have going on, they may be able to file, or an individual will file because they file taxes. A question we get a lot is, what about disregarded entities, single member LLCs? They don't file their own taxes. So in our interpretation, understanding that you would just include that activity underlying your individual tax return and file that way. But again, that could change tomorrow for all we know. But.
Yeah, and they also look at the term trade or business. So meaning if you're a real estate investor that you have rental properties, that's one trade or business. And maybe you're also a broker or a wholesaler, again, in an S Corp or Schedule C, that's generally another trade of business for tax purposes. So, that's how we're kind of interpreting that right now in terms of by businesses.
Okay. Maybe a question for Kathleen. I'm not sure, and Dad, your opinion here.
Okay.
What is going to happen with the hedge funds who bought all the REOs and decided to rent? Do you think they will liquidate?
Honestly, most of them are probably held in vehicles that are long-term, like REITs. They're single family. It's almost like having a scattered apartment, in my opinion. And I've talked to John Burns about that. So I think a lot of those properties are really permanent rentals that are in vehicles that really are not something that intend to be liquidated. And as a matter of fact, probably are doing much better than some of the other hedge fund investments that they could have had. So real estate's really not the damage path right now for most investors. It's been taking on stocks primarily.
Kathleen, I don't know if you've been following any of that activity on the note side too. I mean, I've heard a lot of hard money lenders of the Wall Street variety that have just up and left or severely changed their programs, especially if they were using lots of leverage. Any thoughts on that?
I think that right now there's not a lot of ability to determine the actual market price of assets. And so as far as investment tomorrow and what are hedge funds going to be buying, I think right now they're looking at gold and Bitcoin. Gold on the short term and Bitcoin maybe on a 5-year time horizon as a replacement for fiat currency. But I do want to mention that I saw a very interesting interview and with a gal, her name is Pippa Malmgren, of all things. And her father was Harold Malmgren, who was in the Reagan administration. And Pippa has a PhD in economics, and she's a business person. And she has been a consultant in the Bush administration and other administrations. And she was asked to write a memo to our government and another government about forming a version of the RTC. So if you remember in the SNL crisis, most of us weren't even born then, but in the 70s, the SNLs crashed and they had all these assets. So the government set up a corporation called the Resolution Trust Corporation, and they took all of these distressed assets from the SNLs and savings and loans, and they put these into this RTC, and the RTC then valued them and auctioned them off. So Pippa was asked to write a memo, and in this interview, she was saying that the government in the United States is very interested in forming private-public partnerships. So there are two entities, BlackRock being one and PIMCO being the other, that are in line to be the new RTC, if you will, on behalf of the federal government. So what I see is I see the Fed buying a lot of bonds. They're buying a lot of this debt, and they're providing liquidity to the market. And by that, they're holding the market up. So I think Lenska was very appropriately talking about the BBB rated bonds, which if a corporation falls into BBB, then the pension funds have to sell their debt. They have to sell those bonds. And the federal government has been buying them and putting a floor under that market so that it doesn't crash. Right. And that corporations can still go out and borrow, hypothetically, because I don't know anybody that's getting a brand new loan right now. But that's what the government's been doing. Now, let's just walk through this for a moment. So let's say that the Fed puts money and they buy these bonds of these corporations that have no cash because they spend it all buying back their shares.
Right.
And now they're failing. So then what happens? The business is failing, it goes bankrupt, or it says, hey, I can't perform on my bonds. And who's holding those bonds? Well, the federal government bought those bonds. The Fed did. What does the Fed do with those bonds that are now in default? Well, they hand them off to BlackRock or PIMCO. BlackRock or PIMCO put a valuation on them, and then they sell them to the highest bidder. So who's going to bid for those assets? Well, you know, if some of those assets are mortgage-backed securities, and I'm in the real estate business, and I know about real estate, and I understand how to value real estate assets, I might put together a pool of funds, and I might go bid on those assets. So you asked me about hedge funds, and you asked me about BlackRock, and you know some of these groups that own these assets. Well, that's why that's why the federal government is considering BlackRock for this kind of a thing, because some of those assets are going to be real estate related.
Yeah.
And if I can add to it, that if you also watch, on some of the tickers that they are raising already money for certain REITs or purchases. So I was always wondering, what are they raising the money for? So thank you for solving that puzzle for me, Kathleen.
Yeah, in fact, one of my favorite investors is this guy named Howard Marks. So if you know who, he's number one debt buyer in it probably, and he started a company called Oaktree about 30, or actually they just celebrated 25 years. I think I got a newsletter from them. So they buy distressed real assets, and they buy distressed debt. And they put together an opportunity fund last year, at the end of last year, and it's traded on the New York Stock Exchange. So you can Google it. I'm not going to give you the call sign, but you can go out and Google it. And they're raising money right now. They're selling shares, and they've got about, 250 million right now in cash. It's just sitting there in cash. So you can go look at their SEC filings and see what they're doing, but they're just sitting in cash waiting to buy these distressed assets. And that's pretty interesting.
And noted that the Fed started QE in September 2019. So somebody knows something we don't know.
Great segue into some political stuff. And Paul, I'm going to be coming your way on this one. The question was raised, does it matter who is president next? Dad, you got any thoughts on that?
Oh, jeez. I think it's unlikely that we have a change. I guess that's bottom line. I wish we had other choices, to be quite honest with you, but I think we will stay with the president that we have. It's hard to imagine him being replaced by the candidate that we've got. So I just hope, this is beyond who's president, I hope for something like this pandemic and the seriousness of it. And we have shown some signs that we are possibly can act like Americans instead of Republicans and Democrats. I think that would be a really important thing for the next 4 years.
It would be nice. We'd have to get all parties to
grow up.
Yeah. Paul, one of the reasons I wanted your opinion on this was because if, California is a great example of a state sort of that's very liberal. We have a majority liberal state and House, making it very easy to pass policy. They're trying to change things to make it easier for them to pass things without the other party involved, just skirting them altogether. Is there anything that NAR or the California Association of Realtors in particular is worried about if we have a Democratic president? Uh-oh, can't hear you. Oh, hang on. Let me unmute you. Sorry, that was my fault. Go ahead.
Okay,
sorry.
Oh, okay. I kept trying, it wouldn't let me, so I didn't know you were blocking me. It's probably not a bad idea to keep the political guy out of the conversation.
No.
It gets depressing. Well, there's always a concern that gridlock can be our friend in some cases because it avoids bad things from taking place. And if you get a wild swing the other direction, then some things that are off the table suddenly come onto the table. That said, in a scenario in which we're in a economy that is going to have a lot of cracks in the foundation, and a lot of it related to how government finances itself, especially at the local and state level. A lot of those really ambitious ideas that might be more of an issue for a long-term marketplace might not be on the table at that point, because you're just trying to figure out how to deal with pension obligations and funding local services and state services, and the federal government being the last remaining piggy bank that is able to borrow and use those funds. So are there some concerns? Sure, but you never know how the politics of that are going to work. We spent a generation trying to protect the mortgage interest deduction, believing that Democrats would be the ones to undo that one. As it turned out, it was the Republicans who undid it in the tax reform that basically made it useless to most Americans. So you just don't know how that's going to function in any given administration.
Well, I feel like maybe we should revisit this in another month or so if everyone's willing. We'll work on that. It's just getting really late, and we've got some of the speakers that need to go.
Yeah. Thank you for participating, man. We really appreciate that.
Is there any, David, any of the speakers, anything last you'd like to ask or chime in on?
Thank you very much for letting me participate. You did a fabulous job.
Thank you, David.
All right.
Maybe next time we talk about where the puck's going to go by then.
Yeah, a little more clarity.
Well, we need a few more months before that is more clear.
All right.
Absolutely.
Thank you, Aaron. Thank you, Bruce. I'd love to do this again.
Okay.
And SDCIA will be sponsoring the I Survive, but I'm voting for getting out of our PJs.
Sounds good. All right, everyone. Have a great night. Thanks so many people for hanging in with us for such a long session, and hope you found it helpful.
Thank you.
Thank you, everybody.
Thank you.
Thanks, Aaron.
Bye.
Good night. The Norris Group originates and services loans in California and Florida under California DRE license 012-19911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.